Please like, share, and subscribe. Wishing you happiness and good luck every day.
So what's the real difference between a professional trading system and, just a gut-feeling gamble? It's a huge question, and it gets right to the heart of how markets really work. Today, we're going to peel back the curtain and see how the pros move beyond pure instinct to build a deliberate, repeatable system that actually works. We've all seen this kind of thing in the movies, right? It's pure chaos, super high stakes, all driven by raw emotion. And yeah, it makes for great cinema, for sure. But in the real world, relying on that kind of instinct is pretty much a one-way ticket to blowing up your account. And look, this isn't just some Hollywood thing. Author Robert Carver tells this amazing story from his very first day on a trading floor. He was asked to make his first trade with someone else's money, and he just completely panicked. He froze up, and with zero logic, zero system to fall back on, he just clicked buy. It's that moment of total uncertainty where your gut takes over and you just feel like you have to do something. But of course, Carver didn't stay in that world of just panic clicking. He moved into a world of systems, of taking deliberate action. And that's what brings us to the pros playbook. That whole experience, that panicked first trade, it taught him a huge lesson. There had to be a better way. The solution wasn't to feel the market better, it was to trade deliberately, using carefully designed strategies. And this book, Advanced Futures Trading Strategies, is our source material for today, and it lays out that exact playbook. So, what's at the heart of this whole playbook? It's all about something called a systematic trading strategy. This isn't about your gut feelings or some hot tip you got from a friend. No, it's a set of super clear, totally objective rules. You define every single action in advance, which takes all the emotion and guesswork out of it. You just follow the instructions. No ifs, ands, or buts. Okay, so to really see how deep this rabbit hole goes, we're going to take a look at what sounds like the absolute simplest strategy you could ever imagine, a basic buy and hold. All right, so our test case is going to be strategy 1 from the book. Just buy and hold a single S&P 500 futures contract. I mean, it sounds almost laughably simple, right? You buy a thing and then you hold it. What could possibly be complicated about that? Yeah, on paper, it's just 3 steps. Step 1, pick your market, the S&P 500. Step 2, buy 1 contract. And step 3, hold on. Easy, right? Well, not so fast. Because in the world of futures trading, that third step, hold it, that's where a huge hidden problem is lurking. And that huge problem is this. What happens when the thing you're holding just expires? Like it literally ceases to exist. And this gets us right to a fundamental issue with trading futures, the problem with time itself. Think about it. If you buy a share of Apple stock, you can hold onto that thing forever, right? But a futures contract, well, it's a temporary agreement. It has an expiration date. An S&P 500 contract, for example, it's gone every quarter. So our buy and hold strategy, it can't be passive. You have to do something or your position is just going to disappear into thin air. So what do? Well, the action you have to take is called rolling. It's pretty straightforward. Just before your current contract is about to expire, you sell it, and at the exact same time, you buy the next one in the series. So you might sell the December contract and buy the March one. This way, you keep your position in the market, problem solved, right? Well, not so fast. Because here's the catch. Take a look at this. The price of the contract you're selling is pretty much never the same as the price of the one you're buying. In this example, you're selling the December contract for $47.06, but you're buying the March one for $46.98. That's a gap of 8.25 points. And this tiny little difference, it creates a massive problem when you're trying to analyze your performance. And that problem brings up a really crucial question. How in the world do you create a true, accurate history of how your strategy actually performed? This, right here, is where professional, systematic trading really earns its keep. See, the amateur way to do this would be to just, download the historical prices for all the old contracts and just stitch them together in a spreadsheet. But every single time you do that, you're baking in that artificial price jump, that 8.25 point gap we just saw. And that has absolutely nothing to do with whether the market actually went up or down. It's like a phantom profit or loss that totally messes up your data. And you can see the result perfectly right here. That jaggedy black line, that's what you get when you just stitch the raw prices together. See all those weird jumps and drops? Those are the rolls. But that smoother gray line, that's what the pros use. It's called a continuous back-adjusted price history. And I mean, look at them. They look like two completely different markets. So, yeah, the obvious question is, why? Why don't they match up? Where is all that difference coming from? And this chart is the answer. This is the roll yield. It's basically the grand total of all those little price gaps from every single roll added up over decades. It creates this massive, massive distortion that, again, has nothing to do with the actual performance of the S&P 500. So to get a true picture of what happened, you have to surgically remove this effect from your data. And that surgical process has a name. It's called back adjustment. It's a special technique where you go backwards in time and you strip out those price gaps at every single roll date. The goal is to create one single, clean, continuous price history. What you're left with is a data series that shows you exactly the profit and loss you would have made if it were possible to just hold one contract forever. So, after all of that super meticulous work, what's the real bottom line? What did the strategy actually do? Let's take a look. It's only now, with this clean, professionally adjusted data, that we can finally run a proper backtest. We can finally look back through history and see how our quote-unquote simple strategy would have really performed without all those fake price jumps getting in the way. And here it is. This is the real account curve. This chart is showing you the cumulative profit you would have made from systematically holding just one S&P 500 microcontract over the years. This properly accounts for every single roll using that true adjusted price history. This isn't a guess, it's the result of a really rigorous process. And the final number? Over $200,000 in profit. But honestly, the number itself isn't even the most important part. The real takeaway here is how we got this number. It's built on a rigorous, systematic foundation. It's not a lucky guess, and it's definitely not a prediction for the future. It is simply the output of an objective, repeatable process. And all of this leaves us with one last question to think about. If this much detailed, painstaking work has to go into just analyzing the simplest strategy you can imagine, what does that tell you about the huge, massive difference between what a professional trader does and just, placing a bet?
All right, let's talk about trading futures. We're going to demystify the whole thing by looking at the simplest strategy out there, buy and hold. This is your blueprint for understanding how this really fundamental approach works, right from the ground up.
You might remember this classic line from the movie Margin Call. It just perfectly frames the whole challenge of trading, right? It really forces you to ask, okay, if I'm going to do this, which one of these paths am I going to take?
So let's break these options down. Cheating? Well, that's illegal, so we're just going to toss that one out right away. Being first? That's the world of high-frequency trading. It's basically a multi-million-dollar tech race that most of us just can't compete in. So, that leaves one path for the rest of us, being smarter. But what does being smarter even mean? It's not about finding some kind of secret code or a magic formula. Not at all. Being smart is really about understanding and quantifying the risks you're taking, making sure you're getting paid enough for those risks, and maybe most important of all, just avoiding the really dumb mistakes. So here's our game plan. We'll start with why being smarter the way to go. Then we'll look at a super simple one-trade approach to the market. We'll dissect a futures trade, learn how to time travel with data, get to the bottom line of profit, and then we'll talk about a huge pitfall called the backtesting trap. Okay, so let's dive into this simple path to smarter trading. Look, the most famous risk in all of finance is equity risk, right? You get paid to hold stocks because they're riskier than just holding cash. The real question is, what's the absolute simplest, most efficient way to get that exposure? I mean, you could try to buy all 500 stocks in the S&P 500, but think about how crazy expensive and complicated that would be. Or you could do something way, way simpler. You can get exposure to that entire index by buying just one thing, a single futures contract. And that's our baseline strategy.
But to actually do that, we've got to get into the nitty-gritty of how these contracts work. So let's break down the basic anatomy of a futures trade. We'll use the S&P 500 Micro E-mini contract as our example. It's a popular one.
First up is the multiplier. Think of this like the contract's gear ratio. For our Micro E-mini, the multiplier is $5. That just means for every single point the S&P 500 index moves, up or down, the value of our contract changes by $5. Simple as that.
Next, you've got the tick size. This is just the smallest possible step the price can take. So the price can't move by, say, 0.1 points.
Nope. It can only move in these little jumps of 0.25 points. It's the minimum increment. Okay, so this is where it all clicks into place. Your total market exposure, what they call notional exposure, is just the index price times that multiplier we just talked about. So let's say the S&P is at 4,500, you multiply that by $5, and boom, one tiny microcontract is giving you control over $22,500 worth of the stock market. That is leverage right there. Now there's a catch with this whole buy and hold idea. A stock you can hold forever. But a futures contract, it has an expiration date. So if you want to hold a position for years, what in the world do you do when your contract is about to die?
The answer is a really important process called rolling. It sounds complicated, but it's not. Before your current contract expires, you just sell it, and at the same time, you buy the next contract that expires later. That's it. It's a swap that lets you keep your exposure to the market going and going. This is absolutely critical for any long-term futures strategy.
So, we know we have to roll our contracts, but this creates a huge headache when we try to look back at historical data to see how our strategy would have done. I mean, how do you build an accurate picture of the past when you keep switching contracts?
Well, if you just naively tape together the historical prices of each contract one after the other, you get this absolute mess. You see those huge, sharp drops? Those are not real market crashes. They're totally artificial price jumps that happen just because you're rolling from one contract to another that's trading at a different price. It gives you a completely bogus picture of your performance.
So the fix is a clever technique called back adjustment. What it does is it mathematically erases those artificial price gaps caused by rolling. It creates one smooth, continuous price history. That's the gray line you see here. This adjusted data finally shows you the real profit and loss you would have actually experienced. It's like cleaning up the timeline.
Okay, now that we have this clean, accurate history, we can finally get to the big question. What's the bottom line? How much money would this super simple buy and hold strategy have actually made over the years?
The calculation is actually really straightforward. First, you figure out the change in that back-adjusted price, and you measure it in points. Then, you just multiply that number by the contract's multiplier, which for us is $5. And that's it. That gives you your profit in US dollars.
So for example, if that adjusted price moves up by 45 points, you just multiply 45 by that $5 multiplier. Your profit for that period? $225. See? Pretty simple. All right, we've got the theory, we have the right data, we know how to do the math, so let's run the numbers. If you had started this super simple strategy way back in the early 1980s and just held on for dear life, what would the result be today?
And here it is. This chart, the account curve, shows you the total profit piling up over time. Just by buying and holding a single micro S&P 500 contract since the early 80s, you would have generated over $200,000 in profit.
But you know, profit without context is meaningless. You have to ask, how much money did you need to tie up to make that profit? This chart is awesome because it shows you both. The dark gray line is your profit, and the light gray line is the capital you would have needed, assuming you didn't use any leverage. And as you can see, they track each other pretty closely.
Now, that performance looks pretty incredible, right? But hold on. This brings us to our last, and honestly, our most important section. We have to be so careful when we look at historical results like this, because the past is not a perfect guide to the future. This is what's known as the backtesting trap. See, we're looking at history with perfect 20/20 hindsight, which is a luxury we will never have in the future. This leads to something called overfitting, where you mistake random noise for a real repeatable pattern. The source gives a hilarious example. What if your backtest showed that all the best returns happened on January 26th? It would be totally absurd to build a strategy that only trades on that one day, right? That's overfitting. And it's why backtested results almost always look way better than what you'll get in real life.
And that leaves us right here with the final critical question. We know the past isn't a perfect crystal ball, and we know that just chasing what worked before is a trap. So the real challenge isn't just about finding what worked in the past. It's about understanding why it worked, and then asking, how do you build a strategy that's strong enough, that's robust enough, to handle a future that is guaranteed to look different than the past?
Okay, so let's get right into it. We're going to talk about a professional way of thinking about investing that pretty much flips the usual questions on their head. You know, most people start out by asking, how many shares should I buy? Well, today, we're going to see why that's actually the very last question a professional trader answers. And check this out. This quote comes straight from a guy who used to manage money at a major hedge fund. See, the process doesn't start with a gut feeling about an investment. It starts with a fixed pile of cash. The position size? Well, that's a calculation, not some wild guess. And he says it right there. That is the correct order. It's a huge shift in thinking. And that's really the big question for us today, isn't it? How do we get from point A, this pile of capital, to point B, a really intelligently calculated position size? How do we bridge that gap? Well, let's break it down. Here's how we're going to tackle this. First, we're going to reframe the question professionals are really asking. Then we'll get into how to measure an investment's risk in actual dollars and cents. After that, we'll use that number to scale our position. Then comes the really important part, finding your personal target risk. And finally, we'll see how this all creates a whole new mindset. All right, first up, measuring an investment's risk. You've heard the saying, you can't manage what you don't measure. It's so true. Before we can even dream of controlling our risk, we have to actually quantify it. We need a solid number that tells us how much this thing, well, how much it wobbles. So to make this really concrete, we're going to stick with one single example the whole way through, an S&P 500 Micro E-mini futures contract. Now, the notional value, that's just a fancy way of saying what it's really worth, is $22,500. And looking at its history, its typical annual volatility is about 16%. That's 16%. That's the annualized standard deviation. Now, I know that sounds super technical, right? But it's not. Just think of it like this. It's the asset's typical wobble over a year. A bigger number means a bigger, wilder wobble. A smaller number means it's a lot more stable. And that's the key metric we need. And here's where it gets really useful. We can take that kind of abstract idea, that 16% wobble, and we can translate it into a real-world dollar figure. All we have to do is multiply it by the contract's total value. And here it is, $3,600. This is so important. Holding just one of these contracts means you're taking on an average annual risk of $3,600. This isn't a guess, right? It's a calculation based on how much this thing typically moves in a year, measured in dollars. Okay, but what does that $3,600 number actually feel like? What does it mean for you? Well, statistically speaking, it means that about 1 out of every 6 years, you could expect this one contract to have a bad year and lose you more than that amount. That's what that wobble means in real life. Suddenly, the risk feels a lot more tangible, doesn't it? Okay, so we've got our magic number. We know one contract has about $3,600 of annual risk baked into it. Now we can build the engine that uses this number to tell us exactly how many contracts we should be holding. So the first step is to figure out your total risk budget in dollars. And it's pretty simple. You just take your total capital and multiply it by a percentage that you choose. We'll call it your target risk. We're going to talk a lot more about how to pick that percentage in a bit, but for now, just think of it as the total amount of wobble you're comfortable with across your entire portfolio. And the other part of the equation? Well, that's the number we just spent all that time figuring out, the dollar risk of a single contract. In our example, that's our old friend, $3,600. So we have our total risk budget, and we have the risk per unit. And boom, here it is. The logic is so beautifully simple. The number of contracts you should hold is just your total risk budget divided by the risk of one contract. Let's say you decide you want to take on $7,200 of risk, and we know each contract is $3,600. Will you buy 2? It is that simple, and it's that powerful. Okay, this brings us to what is easily the most important and the most personal part of this whole formula. The math is easy, right? But it all hangs on one number that you and only you can decide for yourself, your target risk. You'll see it represented by the Greek letter tau sometimes, but don't let that scare you. It's just a symbol for a very personal choice. So the formula is this awesome engine, but it needs fuel, and that fuel is your personal target risk percentage. So, the million-dollar question is, how on earth do you pick your number? Well, it's not a random guess. There's a really structured way to think about it. We're going to figure it out by looking through 4 different lenses. First, what's the absolute max the exchange will even let you do? Second, what do you need to survive a sudden, nasty market crash? Third, what's your personal gut-level comfort with ups and downs? And fourth, what does history tell us is the optimal level? You do all 4 checks, and your answer is always the lowest, most conservative number of the bunch. And, thinking about worst-case scenarios isn't just some academic exercise. Let me tell you about the Swiss franc back in 2015. It was supposed to be one of the safest, most stable currencies on the planet until one day it wasn't. In literally a matter of seconds, it dropped 16%. Anyone who was over-leveraged because they thought it was safe got absolutely wiped out. You have to plan for these things. Now, to find your personal comfort level, it can really help to have some benchmarks. A really conservative bond portfolio might have a risk around 5%. A classic 60-40 mix of stocks and bonds, that's closer to 12%. And an all-stock global portfolio is around 15%. Where do you feel like you fit on that spectrum? It just helps ground your decision in reality. And finally, we can just ask the data. What's worked best in the past? If you look back at a simple buy and hold strategy on the S&P 500, the sweet spot for risk that maximized long-term growth was somewhere between 23 and 40%. Any more risk than that, and the crazy swings start to hurt your returns. Any less, and you're leaving money on the table. Okay, let's bring this all home and talk about the new mindset this whole process creates. Because once you start putting these pieces together, it does more than just give you a formula. It fundamentally changes how you see the entire market. It all boils down to this, right here. You completely stop asking, how many shares should I buy? And you start asking a much smarter question. How much risk should I take? Just making that one simple switch forces you to be disciplined, to be systematic, and to be intentional with every single dollar you have. And that's really the big idea I want you to walk away with. When you start with your capital and your chosen risk target, every single position you put on becomes part of a coherent, unified strategy. You don't see individual stocks anymore. You see units of risk that you are carefully allocating from a budget you created. And that, my friends, is the difference between amateur guessing and professional risk management. Welcome to the Explainer. Today, we're going to tackle a really sophisticated trading strategy by looking at something surprisingly simple: sailing a boat. Okay, let's start with this. This quote from financial author Robert Carver. It just perfectly sets the stage, right? It's a really simple but powerful warning. In sailing, and definitely in the markets, if you fail to adjust to changing conditions, well, you could end up swimming. And that really brings us to the core question for today's Explainer. We're going to break down a pretty clever strategy for managing one of the biggest, most unpredictable challenges in all of investing: volatility. So, to get started, just imagine this. You're a sailor, right? You set your sails perfectly at the start of a long trip, and then you just lock them in place. You never touch them again, no matter what the weather does. Sounds kind of crazy, doesn't it? Well, in investing, that's basically what a fixed risk strategy is. You just decide on a risk level and stick to it, come what may. Now, on paper, that fixed strategy might look okay on average. But as you can see from this chart, the actual journey is anything but average. It is filled with these terrifying storms. You could call them financial hurricanes, like the '87 crash, the 2008 crisis, and the 2020 pandemic mess. In those moments, you're suddenly exposed to 6 times more risk than you ever signed up for. You might not capsize, but you're in for one heck of a wild ride. Okay, so that's the problem. But what if you could be like one of those experienced sailors who just looks at the clouds, at the waves, and gets a pretty good sense of the weather that's just ahead? Well, it turns out you kind of can. And it's all thanks to this phenomenon called volatility clustering. You see, while trying to predict if the market's going to go up or down is, well, it's basically impossible. It's surprisingly easy to predict how choppy the seas are going to be tomorrow just by looking at how choppy they are today. A stormy day is very likely to be followed by another stormy day. And a calm day? Probably followed by another calm one. Now, to actually use this idea, we can't just, stick a finger in the air. We need a reliable tool, a better compass, if you will, to measure the current financial weather with some real accuracy. And this slide shows why not all tools are created equal. They are definitely not. Look at the chart on the left. That's the simple average. See how jumpy and noisy it is? It's not very helpful. But the one on the right, now that's a different story. It uses a smarter method called an exponentially weighted moving average. I know, it's a mouthful, but all it really means is that it pays more attention to what just happened. And look at the result, a much smoother, much more stable, and way more useful forecast. And here is how to make that forecast even better. The system blends that really reactive, short-term view with a very stable long-term average of risk. This stops the strategy from getting way too aggressive during those weirdly calm periods that sometimes happen right before a huge storm hits. It's really the best of both worlds. It's responsive, but it's also anchored. So now that we have our reliable weather forecast, how do we actually use it to adjust the sails of our portfolio? This formula right here is the engine of the whole strategy. And the logic is just beautiful in its simplicity. Your position size is inversely proportional to the risk forecast. So think about it. When the forecast for risk goes up, meaning a storm's brewing, your position size automatically goes down. You pull in your sails. When the forecast is calm, your position size goes up. You get to catch more wind. And here is what that looks like in action. This chart is pretty incredible. Look at what happened in 1987. As the market started to crash and volatility just skyrocketed, the system saw that storm coming and automatically cut the position size dramatically. It protected the portfolio right when it was most vulnerable. But of course, there's no free lunch, right? Constantly adjusting your sails, or in this case, your portfolio, means more frequent trading. And more trading always comes with costs. So the key here is to measure these costs intelligently. Instead of just looking at the dollars and cents, this strategy measures cost relative to the risk of the asset you're trading. This risk-adjusted cost lets you make a fair apples-to-apples comparison between, say, the cost of trading a volatile stock versus a stable bond. Okay, so after all this work, forecasting the weather, adjusting our sails, and carefully accounting for the costs of doing all this, what's the final result? Was the journey actually any better? Well, this slide gives us the visual proof, and it's pretty stunning. On the left, you can see the wild, unpredictable journey of that fixed-risk sailor just getting tossed around by massive waves in 2008 and 2020. On the right, you see the journey using our variable strategy. Those massive, portfolio-threatening spikes in risk, they've been tamed. They're just manageable swells now. It's a much, much smoother ride. And the data backs up what our eyes just told us. The annual return is virtually identical for both. But now look at the risk, measured by standard deviation. The variable strategy was significantly less volatile. And what that means is it achieved a better risk-adjusted return, which you can see in the higher Sharpe ratio. So it's not about getting more profit, it's about getting the same profit with a whole lot less drama. So ultimately, this whole approach isn't about having a crystal ball to predict the future. It's about building a better system to intelligently adapt to the present. You can't stop the storm, but you can prepare your ship. And that leaves us with a final, kind of provocative thought. Mastering risk isn't just a defensive move about safety and avoiding losses. If you can confidently navigate the storms, it opens up a whole new world of possibilities for where you can choose to sail next.
All right, welcome back. Today, we're going to challenge a really common belief about how to build a safe investment portfolio. We're going to show you why just focusing on where your money is can be super misleading, and how focusing on risk instead can lead to much smarter and way more resilient results.
You've probably heard of the classic 60-40 portfolio, right? 60% stocks, 40% bonds. It gets thrown around all the time as the gold standard for a balanced approach to investing. But, as this slide asks, is it really balanced? The answer might just surprise you.
I mean, if you just look at where your capital is allocated, it seems pretty straightforward. 60% of your cash is in stocks, 40% is in bonds. Looks balanced enough on the surface, doesn't it?
Okay, but here's the twist. When you stop looking at the dollars and you start looking at the risk, the whole picture just flips on its head. Because stocks are so much more volatile than bonds, they're actually contributing a massive 75% of the portfolio's total risk. And this hidden imbalance is where things can get really tricky.
And that right there, that huge concentration of risk, that's the big flaw. Think about it. If almost all your risk is tied to the stock market, a bad year for stocks can absolutely hammer your entire portfolio. That 40% in bonds suddenly doesn't feel like much of a safety net at all.
So what's the alternative? Well, this brings us to a really powerful idea called risk parity. The whole idea is to stop thinking about splitting your capital 60-40 and instead focus on making sure each part of your portfolio contributes an equal amount of risk. The goal is true, genuine balance.
Okay, so how do we actually do this? How do we build one of these truly balanced portfolios using the risk parity method?
Well, it's not about gut feelings or guesswork. It's actually a pretty calculated approach to figuring out how big each position should be.
The secret sauce is a formula like the one you see here. Now, don't worry, you don't need to memorize this thing. The concept is what's really important. Basically, it just looks at how volatile, or, how bouncy an asset is, and then it tells you exactly how much of it to own. That way, a really risky asset, and a super stable one, can be weighted just right so they both pull the same amount of risk weight in the portfolio.
And check out what happens when you do this. To get to a true 50-50 times risk balance between stocks and bonds, your capital allocation totally flips on its head. You actually end up putting less money, only 42%, into those volatile stocks, and a lot more, 58%, into the more stable bonds. It's kind of counterintuitive, right?
Okay, so we've balanced the risk. Great, but this is where the real magic of this strategy kicks in. Let's call it the diversification surprise. Just take a look at these numbers. The standard deviation here, which is really just a fancy way of saying risk, is 15.1%. But what's really interesting is the Sharpe ratio. Think of it like a bang-for-your-buck score for your investments. It jumps from around 0.55 for the individual assets all the way up to 0.79 for the combined portfolio. Long story short, you're getting way better returns for the amount of risk you're taking.
So how is that even possible? How can combining two things make them better? Well, the secret is something called correlation. During this time, the correlation between stocks and bonds was negative 0.004. I mean, that's basically zero. It just means when one zigs, the other zags. They don't move together, and that's what smooths out the journey for you. Okay, so now we have this smoother ride, this awesome diversification benefit. We can actually harness that and turn it into higher returns. Now, by carefully, and I mean carefully, applying a bit of leverage, we can dial the portfolio's total risk back up to whatever our target level is. So we end up taking on the same amount of risk, but now with a much, much higher expected return because of that diversification.
And this chart just shows you the result perfectly. That solid line, that's our risk parity portfolio. You can just see with your own eyes how much smoother and more powerful that growth curve is over the long haul compared to just holding stocks or bonds on their own.
So this two-asset portfolio is great, but it's not perfect. What happens if you hit a rough patch where both stocks and bonds are struggling? Like during a period of really high inflation? For that, we need to upgrade our thinking a bit.
And that's where the famous all-weather portfolio comes in. The whole idea is to build in even more resilience by adding more asset classes that don't move together. So we start bringing in things like a whole basket of commodities, and of course gold, which tend to dance to their own beat, especially compared to stocks and bonds.
Really, the goal is simple. You're trying to build a portfolio that has something in it that's designed to do well no matter what the economic weather is. So whether the economy's booming or in a recession, whether inflation is high or low, you've got a part of your portfolio that's prepared for it.
Now, the great thing about this is it isn't some secret black box strategy that's only for giant hedge funds. Risk parity is actually a really flexible framework that you can use to kind of handcraft your own strategy.
Yeah, you can totally build your own version using a pretty simple top-down method. First, you just group your investments into big buckets, like equities, bonds, commodities, and so on. Then you give each of those buckets an equal slice of the risk pie. And finally, within each bucket, you just divide that risk up equally among the specific things you own. It's a great way to get broad, risk-balanced diversification without getting lost in the weeds. All right, so what happens when we take this whole idea of diversification and just take it to the absolute extreme? This is where the power of scale really delivers an incredible payoff.
Just look at this chart. This is what happens when you create a jumbo portfolio. It applies that same risk parity principle but across more than 100 different instruments from all over the world, all chosen because they don't move in sync with each other.
And the results? They're honestly staggering. Remember that bang for your buck number, the Sharpe ratio? Well, if you picked any single one of those 100 instruments at random, its median Sharpe ratio would be about 0.32. But when you combine them all using risk parity, the entire portfolio's Sharpe ratio leaps up to 0.85. That is almost triple the performance for the amount of risk you're taking on. It's incredible.
So the key takeaway here is just crystal clear. Like the quote says, just by going from one instrument to 100, you can almost triple your expected risk-adjusted return. This isn't just about adding more stuff. It's about intelligently balancing the risk across a huge, diverse set of assets, and that becomes an incredibly powerful engine for growth.
And all this really leaves us with one final big question. For so long, we've been told that investing is all about picking winners, right? Finding that one stock that's going to go to the moon. But what if that's not the secret? What if the real path to building lasting wealth isn't about finding the needle in the haystack, but about mastering the art of owning the entire haystack intelligently?
You know that feeling, right? Every investor does. You put together what you think is a solid portfolio, but there are always one or two things in there that just seem to be constantly losing money. It's one of the most frustrating parts of investing, and today we're going to dig into a strategy that tries to fix exactly that.
And this quote, man, it just nails that feeling, right? It's not always the big, sudden crashes that get you. Sometimes it's that slow, agonizing bleed from a couple of assets that are just stuck in a downtrend. It makes you wish you could just sidestep them completely.
So, what's the dream here? What if you could have a simple, rules-based system that just filters your portfolio for you? A system that helps you hold only the stuff that's actually trending up? Well, we're about to explore a strategy that aims to do just that.
All right, so let's dive in. We're going to explore this idea of slow trend following, and we're going to build it up from a really basic concept into something much smarter and, well, much more effective.
Okay, so the goal here is super simple, right? We need to build a filter, a totally mechanical rule that can look at any market, stocks, commodities, whatever, and give us a straight answer. Is this thing generally going up or not? If the answer is yes, we invest. If it's no, we stay out. Simple as that.
So, how do we actually build this thing? Well, we're not just going to pull a perfect solution out of a hat. We're going to do it step by step. We'll start with the most basic idea you can think of, see where it breaks down, and then improve it until we've got something really solid.
Our little journey here is going to have 3 parts. We'll start with a really simple attempt, then we'll see why we need a smoother approach, and finally, we'll land on a refined final solution. Let's get started with step 1.
Okay, attempt number 1. This is about as simple as it gets. You just take the average price over the last year, which is about 256 trading days. The rule is, if today's price is above that long-term average, we say it's an uptrend. Makes sense, right? It's intuitive. But as you're about to see, its simplicity is its biggest problem.
And yeah, look at that. It's a complete mess. The price is just constantly whipping back and forth across that average line. In fact, our source material points out that in late 2018, this rule would have told you to trade 14 times in just a few months. That is not a trend signal, that's just chaos. We need something better.
So, how do we get rid of all of that noise? The trick is to smooth out both sides of the equation. Instead of comparing the choppy daily price to our slow average, what if we compare a fast average, let's say over 64 days, to our original slow 256-day average? And boom, the result is so much cleaner. This is called a moving average crossover, or MAC for short. Just look at the chart. Those huge downturns, like after the dot-com bubble or during 2008, are now crystal clear. You can see exactly when the fast line dips below the slow one. This is a massive improvement.
But we can still make it a little bit better. There's one final, tiny refinement. See, a normal average has a weird quirk. When a really old price from a year ago drops off the calculation, it can cause the average to suddenly jump, even if nothing really changed today. The fix for this is called an exponentially weighted moving average. All that means is that it gives more importance to recent prices. Think of it like memory. What happened yesterday is way more important than what happened 256 days ago.
And that brings us to our final, beautiful solution, the EWMAC. Now, don't let the formula on the slide scare you, because the rule itself is just so elegant. We are in the market, we are long, only when the fast 64-day exponential average is above the slow 256-day one. That simple comparison is the powerful on-off switch we've been building this whole time.
All right, so we've built our filter. It's robust, it's clean. Now for the fun part. How do we actually use this thing? Let's look at how it works as a simple but really powerful on-off switch for our portfolio. Here's how it works in practice. Every day, you figure out your ideal position size, how much you want to own based on your risk rules. But, and this is the key, you only actually hold that position if our EWMAC filter is flashing green, if it says on. The second that filter flips to off and signals a downtrend, you sell, you get out completely. Go to cash, period.
And check this out, this is what it actually looks like for the S&P 500. That vertical line shows our position size. You see these long stretches where we're fully invested, and then bam, these sudden drops to zero. Those are the times our filters screamed, "Get out," and saved us from being in the market during a nasty downturn. So we've got this really elegant system. It looks great on a chart, but there's only one question that really truly matters. Does it actually work? Does all this jumping in and out of the market actually improve our performance? Well, the answer is pretty fascinating.
Okay, let's look at just the S&P 500 first. And the results are, well, they're a mixed bag. On the plus side, our average drawdown, that's the biggest pain you feel from a peak to a trough, gets a lot smaller. That's fantastic. But our average return also goes down. And so does our Sharpe ratio, which measures our return for the risk we took. So for a single market, it looks like a trade-off. You get a much safer ride, but you might leave some money on the table.
But, and this is a huge but, what happens when we apply this exact same filter to a big, diversified jumbo portfolio with over 100 different things in it? Well, the results are just incredible. Our average return actually goes up, and look at that drawdown. It gets slashed by more than half, from almost minus 25% down to minus 10. That is a game changer.
The real hero of the story, though, is that Sharpe ratio. It jumps from a respectable 0.85 all the way up to 1.11. That is a massive leap in risk-adjusted performance. It's telling us that when you apply this across a lot of different markets, the filter doesn't just cut your risk. It actually helps you make more money for every unit of risk you take.
And this chart, wow, this chart tells the whole story. The dark line is our filtered strategy. The lighter line is the unfiltered, just buy and hold version. Over decades, the filtered strategy doesn't just end up higher, it completely sidesteps those gut-wrenching, portfolio-killing drawdowns. It's the visual proof of what happens when you systematically just get out of the way of falling markets.
Okay, one last little detail, but it's a super important one. The filter tells us when to be in or out of the market, but it doesn't tell us how to manage our position size while we're in. And for that, there are basically two ways to go, dynamic or static. The static way is simple. When the light turns green, you buy your position and you just hold on for dear life until the light turns red. The dynamic method is more active. You're constantly tweaking your position size every single day to keep your risk levels steady. So if things get choppy, you might trim your position. If things calm down, you might add to it.
So, which one is better? Well, the source material here is pretty clear. It's not even a close fight. The dynamic approach almost always gives you better Sharpe ratios and lower drawdowns. And yeah, it means more trading, but the extra returns you get usually swamp those extra costs. The only tiny reason you might go static is the off chance you catch some insane, unexpected price explosion, but that's a long shot.
So, what's the big takeaway from all this? This slow, trend-following filter is an incredibly powerful tool. It's a systematic way to just avoid those assets that are bleeding your account dry. But notice, it's all about playing defense. It helps you avoid losing money. It doesn't help you make money when things are going down. And that leaves us with one last really juicy question. What if you could take this same idea and flip it upside down to profit from falling markets too? We'll leave you with that thought to chew on. Thanks for joining.
Today, we're diving into a really fascinating trading strategy, one that honestly looks like a total failure at first glance. But it's hiding a pretty powerful secret. It's a method built to make money not just when markets are soaring, but also when they're coming crashing down. So how does it all work? Let's get into it. You probably remember this line from The Big Short. It just perfectly captures this huge, dramatic idea of betting on failure. But what if betting against the market wasn't just some crazy once-in-a-lifetime trade? What if it was a core part of a systematic winning strategy? Well, that's exactly what we're going to explore. So this idea is called going short. And it's simple, really. You're just betting that the price of something is going to go down. Now, our source material points out that for things like individual stocks, this can get kind of complicated. But in the world of futures contracts, those agreements to buy or sell something down the road, it's just as easy to bet on a price falling as it is to bet on it rising. All right, so to really see this thing in action, we're going to look at an automated strategy from our source material. The best way to think about it is like a simple little trading robot. And this robot has just one job: figure out which way the market is trending, up or down. Now, don't get thrown off by all the math you see here. The logic behind this robot's brain is actually pretty simple. It's not trying to predict the future or anything like that. All it does is measure momentum by comparing two different trend lines. One is a fast line that's mostly looking at the last couple of months. The other is a slow line that looks back almost a year. The robot's entire game plan comes down to one question. Is that short-term trend stronger or weaker than the long-term one? The relationship between these two, well, that's everything.
And it all boils down to this one super simple rule. The robot just looks at the difference between those two trend lines. If the fast line is above the slow line, it decides the market is in an uptrend and it goes long. It bets the price will keep rising. But if that fast line dips below the slow one, the robot says, okay, we're in a downtrend, and it goes short, betting on a fall. That's it. One single rule that makes every single decision.
It sounds pretty logical, right? Just follow the trend wherever it's going. But what happens when you actually look at the numbers? Well, this is where things get a little weird. The results are not what you'd expect.
So here's the million-dollar question. We've got this supposedly smarter strategy that can bet on the market going up or down. Does it actually do any better than a basic strategy that just buys stuff and holds on for dear life?
And the answer at first is a big nope. According to the data, when you look at just one average investment, the simple long-only strategy gets you about 6.9% a year. Our fancier long and short strategy, only 4.8%. So on the surface, it looks like being able to bet on failure actually makes things worse. But hold on, because this is where the real story begins.
And that brings us to the real secret sauce here. See, the key isn't how the strategy does on any one single thing. It's about how it behaves when you apply it across a whole bunch of different, unrelated things all at once. This is what we can call the diversification paradox, where the whole is truly greater than the sum of its parts. And boom, here it is, the big aha moment. When you look at the results across an entire diversified portfolio, the numbers completely flip on their head. That simple long-only strategy, it now returns a very respectable 15.4%, but our long and short strategy, the one that looked like a loser just a second ago, it now delivers a whopping 18.5% return. It didn't just catch up, it blew right past it. So how on earth is that possible? Well, the source text gives us a perfect real-world example from the 2020 crisis. The trend for the broad S&P 500 went negative, so our robot went short on the S&P. But at the exact same time, the trend for the tech-heavy NASDAQ was still positive, so the robot was long on the NASDAQ. By holding these two opposite bets at the same time, the strategy kind of hedged itself. It canceled out a ton of risk and was able to profit no matter which way the market winds were blowing. And this chart just says it all, doesn't it? It shows what happens over many, many years. That light dotted line is the simple strategy, and the dark solid line is our long and short strategy. I mean, the difference is just staggering. It doesn't just win, it compounds that win over time, creating this massive performance gap. Okay, but you might be thinking, how can we be sure this is actually because the strategy is smart and not just because it got lucky? It's a fair question. Well, luckily, the experts have a tool for exactly that. They use a statistical tool called a linear regression. And look, you don't need to be a math whiz here. All you need to know is that this formula basically acts like a filter. It lets analysts remove all the gains that just came from the market going up in general. What you're left with is only the performance that was generated by the strategy's own unique decisions. And what's left over after you run that filter? Well, the number is pretty incredible. The strategy generated an extra 13% per year in returns, totally independent of what the market was doing. In the finance world, they call this alpha. And it's pretty much the holy grail of investing. It's the measure of true, repeatable skill. Which brings us to this final thought. We started with a strategy that, on its own, looked like a dud. But when you combined it with the power of diversification, it completely transformed into a massive success. It really makes you wonder, could systematically betting on failure, when done the right way, actually be one of the smartest ways to win? You know, when it comes to trading, we all love a simple rule, right? Something clear and easy. But what happens when that simple rule has a hidden, critical flaw that can absolutely cost you? Today, we're going to dive into a really fascinating concept that transforms a blunt trading signal into a sharp, intelligent tool. Okay, let's just jump right in. What you're looking at here is the S&P 500 right before that massive COVID crash back in March 2020. The solid line, that's the price. Now, the dashed lines, they represent a super simple trend-following signal. The rule is easy.
As long as the fast line is above the slow one, you stay long, you stay fully invested. And, well, you can see what happened. It kept you invested all the way down.
And that's the million-dollar question, isn't it? How could a rule that's designed to follow trends completely miss one of the most violent trend reversals we've ever seen? Why did it fail so spectacularly? Well, here's the flaw. A simple crossover system is basically a light switch. It's either on or it's off. It has no way of telling the difference between a brand new kind of shaky trend, a rock-solid trend that's been going for months, or a trend that is clearly exhausted and collapsing. It treats them all exactly the same. Same bet, same conviction.
So clearly we need a better way. We need to upgrade from that simple on-off switch to something more nuanced, something more like a conviction meter. And that is exactly where this idea of a forecast comes into play. So what exactly is a forecast? Now, in this context, we're not talking about a crystal ball that predicts future prices. Nope. Think of it as a number that tells you how strong and reliable the current trend is right now. It's a way to measure our confidence in the signal we're seeing. I think the absolute best way to picture this is like a volume dial on a stereo. When the music, the signal, is strong and clear, you turn up your position size. You crank it. But when the signal gets weak or choppy, you turn it way, way down, maybe even to zero, without having to wait for the trend to officially reverse. All right, so how do we actually build this conviction meter? Well, we have to take that raw, kind of messy signal from our trend indicator and refine it, polish it into something clean, consistent, and actually usable. This is our starting point. This messy-looking line is just the raw difference in points between a fast and a slow-moving average. I mean, look how inconsistent it is. A 10-point difference back in the 80s when the S&P was at, say, 400, meant something completely different than a 10-point difference today with the index over 4,000. It's an apples to oranges comparison over time. So there are two main problems we've got to fix. First, like we just said, the changing price of the asset distorts the signal. And second, changing volatility does the exact same thing. A 100-point gap between those moving averages means a lot less on a crazy day when the market is swinging 200 points. The solution to both of these issues is the same: risk adjustment. Okay, the transformation happens in 3 clear steps. First, we create a raw forecast by taking our signal and dividing it by the daily volatility. This makes it comparable from one day to the next. Second, we create a scaled forecast. We adjust that raw number so that its average absolute value is always 10. Why? So a 10 for the S&P 500 means the exact same thing as a 10 for gold or oil. It's now a universal language. And finally, step 3, we cap the forecast at plus or minus 20. This is a super important risk management step. It stops us from making ridiculously oversized bets, even when a trend feels unstoppable. And here's the payoff. Look at the difference. On the left, you see that raw, noisy, almost unusable signal we started with. And on the right, you have the final product, a clean, scaled, and comparable forecast. This is the conviction meter we can actually use to make smart decisions. So let's go back to those 3 key moments before the crash. But this time, let's look at our new forecast values. Back in April 2019, when a new trend was just starting, the forecast was low, below 5. We were cautious. In January 2020, during that strong, established trend, the forecast was cranked up to its max, around 20, full conviction. But then, on March 19th, as the market was in freefall, the forecast had absolutely plummeted to less than 1. The conviction was just gone. So we have this powerful number. Now for the most important part. How do we actually use it to size our trades and manage our risk in the real world? Now this slide is where it all comes together. The solid line is our forecast, our conviction meter. The dashed line is the actual position size we'd be holding. And notice, it doesn't just jump from 0 to max. It builds as our conviction strengthens. But look what happens in early 2020. As our conviction, the forecast, takes a nosedive, our position size gets cut dramatically before the worst of the crash even hits. This quote from the source material just nails it perfectly. Our position is cut savagely. Not because some arbitrary line crossed another, but because the conviction in that trend just evaporated. And that proactive cut in risk, well, that's the whole point of this entire system. Okay, this all sounds great in theory, right? It's intuitive, it's elegant, but does it actually lead to better performance? Let's take a look at the back-tested results. All right, looking at the median performance for just a single market, the results are, well, they're a bit disappointing, honestly. The returns are actually a little lower, the Sharpe ratio, which is our risk-adjusted return, is worse, and the average drawdown is actually bigger. This is definitely not the slam dunk we were hoping for at first glance. But things start to look a lot different when we apply this to a large diversified portfolio. Here, the average annual return is significantly higher with forecasting. It jumps from 18.5% to 21.6%. Now, the Sharpe ratio is still a tiny bit lower and the drawdown is a little worse, but that big jump in returns, that's pretty compelling. And here's the crucial piece of context that explains everything. The author points out that historically, most markets have just gone up. There's been a long-term bull market. This naturally favors simpler strategies that just stay long all the time. But once you mathematically correct for that bias, the forecasting strategy actually shows a clear, albeit small, improvement over the simple on-off switch.
So you might be thinking, okay, if the edge is small, why bother with all this extra complexity? Well, the author gives a few really compelling reasons. First, this method actually works even better for faster trading systems. Second, it creates a kind of universal language that makes it way easier to combine different types of strategies. And finally, for the big institutional players, it can massively reduce trading costs by smoothing out trades and avoiding these huge market-moving orders.
I absolutely love this quote. It just frames the value here perfectly. Forecasting isn't some holy grail. It's not a free lunch like diversification is. But it is a smart, intuitive upgrade that adds real value. It's a decent afternoon snack.
And that really leaves us with one final thought to chew on. This whole system is about creating an objective, mathematical measure of conviction to guide how much risk we take. So what if its greatest power isn't just in the numbers themselves, but in giving us a framework to systematically manage our own confidence, to prevent us from being all in when we should be cautious and all out when we should be bold?
All right, today we're going to do something really cool. We're taking a classic trend-following strategy and giving it a massive performance upgrade. We're essentially rebuilding its engine to make it faster, way more responsive, and hopefully more profitable. Let's dive into what makes this new approach, Strategy 8, tick. But first, let me ask you this. Think about your current strategies. Are they built to catch those huge multi-year waves? That's great, but in doing that, are they maybe getting left in the dust by the quicker, sharper moves in the market? You know, the profitable swings that happen over weeks, not years. Well, that is the exact problem we are here to solve today. So, here's our game plan. First, we'll talk about why we even need more speed. Then, we'll get our hands dirty and build the faster filter. After that, we gotta tackle trading costs with a really clever trick called buffering. Then, the fun part. We'll put them head to head and see the results, figure out if we're generating real alpha, and finally, wrap it all up into a new, upgraded trading plan for you. Okay, let's get right into it. Section 1, the need for speed. Let's look at why those traditional, slow, and steady systems can sometimes leave a lot of money on the table. Now, don't get me wrong, slow trend following is powerful. I mean, it's designed to capture those massive, epic bull and bear markets that go on for years. But the market's got more moves than that, right? Even inside a giant bull run, you get these sharp downturns and reversals that are just too quick for a slow filter to even notice. And that, right there, is lost opportunity. So, how do we snatch up those opportunities? Well, we build a better, faster engine. Let's jump into Section 2 and see exactly how we're going to construct this new filter. And boom, this slide shows you the core change right here. Our old slow filter, let's call it Strategy 7, was looking at moving averages over 64 and 256 days. So it's basically looking at the last quarter and the last year of price action. Our new fast filter, Strategy 8, tightens that window a lot. We're now comparing a 16-day average to a 64-day average. We're reacting to what's happened in the last few weeks, not the last few months. It's a total game changer. You know, at its heart, the calculation is beautifully simple. We just take our fast-moving average, the 16-day, and subtract the slower 64-day average from it. If the number's positive, that's a signal for an uptrend. If it's negative, a downtrend. We then scale this raw number to figure out not just the direction, but the strength of the trend. And that's what guides how big of a position we take. Of course, there's a catch, right? A faster system means more signals, which means more trading. and more trading means higher transaction costs, which can really eat into your profits. This is a huge problem, but there is a really elegant solution. Let's get into Section 3, Taming Costs with Buffering. So what the heck is buffering? The best way to think about it is like a noise filter for your trading signals. Instead of jumping on every tiny little change your system spits out, you create a do-nothing zone around your current position. You only actually pull the trigger on a trade when the signal is strong enough to push you outside of that zone. It's all about stopping you from chasing tiny, meaningless market wiggles. The logic here is incredibly straightforward. Step 1, you run your formula to figure out your ideal position. Let's say it's go long 13.2 contracts. Step 2, you create that buffer zone around it, say between 12 and 14 contracts. And step 3, you just look at what you're currently holding. If you're already at 12, 13, or 14 contracts, you do nothing. You only act if you're outside that range. It's so simple, but it's incredibly effective. In this chart, wow, this is where you see the magic happen. That noisy gray line is the raw signal. The dotted line, which just rounds to the nearest number, is still super jumpy, right? But just look at that solid black line. That's the buffered position. It is so much smoother. In just this 3-week period, simple rounding would have made you trade 7 times. With buffering, we made just 1 trade. That is a massive cut in turnover and costs. Okay, so we've built a faster system, and we've made it super efficient. But does it actually work any better? Time for the moment of truth. Let's jump into Section 4 and look at the hard numbers. Okay, this table shows the median performance instrument by instrument. Now, let's focus on our new fast trend, Strategy 8. Yeah, okay, the costs and turnover are a bit higher. We knew that was coming. But look at the payoff. A mean annual return of 6.5%, which just crushes the slow trend's 4%. And maybe even more important, look at the Sharpe ratio, our measure of risk-adjusted return. It's way higher. We're getting paid more for the risk we're taking. But this is where things get truly powerful. When we take all those individual instruments and combine them into one diversified portfolio, the results are just stunning. Look at Strategy 8, a mean annual return over 24%, an average drawdown of just 11%. That's less than half of what you'd get just being long the market. And a Sharpe ratio that breaks above 1, hitting 1.06. It absolutely dominates the slow strategy on every single metric that matters. And there it is, the picture that tells the whole story. The bottom line is just a simple long-only strategy. That middle line is our old slow trend system. And that bold line at the top just consistently pulling away from the others over decades. That, my friends, is the power of our fast system, Strategy 8. The visual proof is just undeniable. And this really highlights how it works in a real-world stress test, the 2008 financial crisis. As the quote says, the slow filter was stuck holding long positions while the entire market was crashing. But our fast filter? It was nimble enough to catch that new downtrend, get short, and actually have its best year ever. That is the power of being responsive when it counts the most. Okay, so the returns are fantastic, but we have to ask, are we just getting paid for being exposed to the market, or is this strategy adding some genuine, unique value? This is what we call the search for alpha. So to figure this out, we use a tool called regression analysis. The easiest way to think about it is like this. Beta is how much of our return is just from riding the market's wave. If the market goes up 10%, how much do we go up? Alpha, though, that's the secret sauce. That's the return we generate that has nothing to do with the market's overall direction. It's proof that a strategy has its own unique edge. And here are the results, clear as day. Look at Strategy 8. Its beta is only 0.38, way lower than the slow strategy. That means it's much less dependent on the overall market just going up. And more importantly, its alpha is 1.55%. It's not just surfing market trends. It is generating a significant amount of extra, uncorrelated return. This is exactly what you want to see. So there we have it. We've proved it's faster, more profitable, and it generates real alpha. Now let's wrap this all up into a final actionable trading plan. And here it is, the complete blueprint for Strategy 8. We start with our scaled forecast, but we put a cap on it to stop us from taking crazy positions. From there, we figure out our optimal position size based on our capital and risk. Then we apply that crucial buffering step. And finally, the simple trading logic. If our current position is inside the buffer, we chill, we do nothing.
If it's outside, we trade to get back to the edge of that zone. That's the whole engine, from start to finish. You know, Strategy 8 is clearly a star player all by itself. But this really brings up an even more interesting question. If it's this powerful on its own, what happens when you start combining it with other, totally different strategies? What if this isn't just an upgrade, but a powerful new piece in a much, much bigger machine? Well, that's where the real art of portfolio building begins. Welcome to the Explainer. So today, we're going to dig into a really common problem for traders. Let's say you've got two great strategies, but you can only pick one. Or can you? What if the smartest move you can make is to actually not choose at all? All right, so here's our plan. We're going to start with that classic fast versus slow dilemma. Then we'll get into this really powerful idea of diversifying your strategy, not just your stocks. We'll look at a whole family of different trading speeds, figure out the art of blending them together, and then, of course, see if the results actually back it all up. Okay, so let's set the scene. Imagine you've developed two trend-following strategies. One is kind of slow and steady. We'll call that one Strategy 7. The other one, Strategy 8, is much faster. And when you look at the historical data, it seems to be the better performer. Now, everything you think you know about trading would tell you to just go with the faster strategy. I mean, look, it has a better Sharpe ratio, which is your go-to for risk-adjusted return. It's the winner. Case closed. Right? Well, the big idea we're exploring today is that this is totally the wrong question to ask. The goal isn't to find the single best player, it's to build the best team. And that leads us right to the heart of this whole thing. The real game changer isn't about choosing or, it's about embracing and. We don't actually have to pick between the fast strategy and the slow one. We can and probably should use both. This quote here really nails it. You know, we all get told from day one to diversify our investments across different assets to lower our risk. Well, this simple but kind of revolutionary idea says we should be doing the exact same thing with our trading strategies. And this slide really shows you where the opportunity is hiding. So our fast and slow strategies, they're highly correlated at 0.70. That means they agree most of the time. But, and this is the important part, they don't move in perfect lockstep. And it's in that gap, that 30% of the time they're seeing the market differently, that's where the magic can happen. You know, once you accept this idea, it opens up a whole new toolbox. It's not just about two strategies anymore. If fast and slow are good together, what about really fast or kind of medium slow? This introduces us to a whole family of trend-following filters. So here they are, a family of 6 different filters. Now, EWMAC is a bit of a mouthful. It stands for Exponentially Weighted Moving Average Crossover. All you need to know is it's just a way to measure the speed of a trend. The numbers, 2, 4, 16, and so on, tell you how fast it is. EWMAC2 is like a hyperactive trader, jumping on every tiny market twitch. Down at the bottom, EWMA64 is our patient tortoise. And somewhere in the middle, you've got EWMA16, which the data says is the best individual performer of the bunch. And this table, this is where things get really fascinating. Once you actually account for trading costs, that super fast filter, EWMAC2, is a total money loser. Its costs are so ridiculously high that they just eat up every bit of profit and more. Meanwhile, as we saw, EWMAC16 is the star player on its own, with the best Sharpe ratio of 1.06. This chart just makes the problem so incredibly clear. Just look at that difference. The transaction costs for the fastest filter are more than 9 times higher than for the slowest one. That is a massive, massive drag on performance that you just can't afford to ignore. This graph tells a really cool story about why you need more than one speed. So before about 1990, all the strategies did pretty well. They were all kind of moving together. But then something in the market changed. The 2 fastest strategies, those black lines, just stopped working. They flatlined or even lost money, while the slower gray lines just kept on climbing. If you had bet everything on just one speed, you could have gotten crushed. Okay, so if some of these filters are just too expensive to run on their own and others do better at different times, how in the world do we combine them smartly to create one single superior signal? The method is actually pretty elegant. To stop one really hyperactive signal from just shouting over everyone else and dominating the average, you first put a cap on how strong any single forecast can be. And only after that do you average them all together. It's kind of like being a moderator in a debate and making sure no one voice gets to drown out all the others.
So it's a very disciplined three-step process. First, you filter. For every single asset you trade, you just toss out any rule that's too expensive to even bother with. Second, you weigh. The strategies that make the cut all get an equal vote, no playing favorites. And then finally, step 3, you boost. You apply this special multiplier to the combined signal to give it the right amount of punch. So this forecast diversification multiplier, or FDM, this is the secret sauce. Think about it, right? When you average a bunch of signals that aren't all pointing in the exact same direction, the final result is going to be a little bit weaker, a little watered down. The FDM is basically a calculated boost that scales that combined signal back up, just to make sure the final forecast has the right level of conviction. So, now for the million-dollar question. Does all this actually work? Is this complicated combined strategy really any better than just picking the single best one to begin with? Well, the data says yes, a big yes. And the proof is right here in the numbers. Our combined multiple trend approach, that's strategy 9, it clocks in with a Sharpe ratio of 1.14. Now that's not just a little better than the slow strategy, it's even better than strategy 8, which was supposed to be our best individual player. By building a team, we've actually created something that's stronger than its strongest member. This performance chart just shows it all so perfectly. Just look at that solid black line for strategy 9. Over the entire backtest, it consistently and smoothly just pulls away from all the others. What we've done is build a system that's more robust and, at the end of the day, just plain more profitable than any of its single parts. And I think the key word here is resilience. Remember how the market seemed to change after 1990? Well, we see it happen again after 2014. That best fast strategy, strategy 8, it starts to sputter a bit. But our combined strategy, it just keeps chugging along because it's also listening to those slower signals that were doing just fine. It's a true all-weather system.
So, what's the big takeaway from all this? Where does this really powerful idea take us next? What's the new mental model we should be walking away with?
The big lesson is this. Stop looking for the one magic bullet. Stop the endless search for the one best indicator or the one perfect strategy. Instead, you need to start thinking like a general manager building a sports team. A diversified team of strategies can cover for each other's weaknesses and end up with a final result that's way stronger than any single all-star could ever be on their own. And that kind of leaves us with one last fascinating thought to chew on. We got these amazing results just by combining different speeds of the exact same type of strategy. So imagine what's possible when you apply this principle even more broadly. What happens when you build a team that has not just trend followers, but completely different kinds of players, like carry strategies or mean reversion? Now that's the next level.
Welcome back. Today, we are cracking open one of the most powerful, but honestly, one of the most misunderstood concepts in all of finance. It's called carry. Now, this isn't some obscure niche idea. It is a hidden engine that's running under the hood in pretty much every market you can think of. And if you really want to get how modern markets work, you've got to understand carry.
Now, if you're thinking, oh great, another dry academic topic, just look at the title of this book, The Dangerous Consequences, Recurring Crisis. I mean, come on, that sounds more like a Hollywood thriller than a finance textbook, right? And that title really sets up the mystery we're going to solve today.
So that brings us right to the heart of it. What is this thing called carry? And why in the world does it have such a dangerous reputation? Well, that's what we're going to unpack together over the next few minutes.
Okay, let's get right into it. First things first, we need a really clear definition. You know, most people think that making money in the markets is all about one thing, guessing which way the price is going to go, up or down. But carry, well, carry is a completely different game. Here it is in a nutshell. Carry is the return you get just for the act of holding an asset. Think about that. You can make money even if the price of that asset stays completely, totally flat. It's a source of profit that has nothing to do with whether the price goes up or down. It's like the income you earn from your investment.
And this simple formula right here, this is the key to everything. Your total return, what ends up in your pocket, is just two things added together. You've got the change in price, which we call spot return, plus the carry. That's it. Two different engines that can drive your profits or your losses.
So you're probably asking, okay, if carry doesn't come from price changes, where does this money actually come from? Great question. Let's dig into that, because the source of carry is actually different depending on what kind of market you're in.
All right, let's start our little tour with something most of us are familiar with, the stock market. Let's just use a big, broad index like the S&P 500 to see how carry works here. For stocks, the logic is actually pretty straightforward. Your carry is simply the dividends you get from owning all those companies, minus what it would cost you in interest to borrow the money to buy those stocks. So, if the dividends you collect are higher than the interest you pay, you've got yourself some positive carry.
Okay, keeping things moving. From the world of stocks, let's hop over to another huge market, government bonds.
And you'll see a very similar pattern here. For bonds, carry is the yield you earn just for holding the bond, minus something called the repo rate. Now, that's just a fancy term for the super short-term interest rate it costs to fund the position. And because longer-term bond yields are usually higher than those short-term borrowing costs, bond carry is, you guessed it, usually positive.
All right, now we're going to jump out of domestic markets and go global into the absolutely massive world of currency trading, or FX.
In the FX market, carry is all about one thing: the difference in interest rates between two countries. A really classic example of this is borrowing a currency with a super low interest rate, say the Japanese yen, and then using that money to buy a currency with a high interest rate. That difference between what you pay and what you earn, that's your carry.
Okay, now for commodities. And I want you to pay close attention here, because this is where the whole idea of carry gets a really fascinating, really important twist.
And you can see that twist right here. Look at the formula for metals on the left. It's kind of like stocks and bonds. You've got costs for borrowing and storage, so carry is often negative. But now look at the formula on the right for things like energy and agriculture. See that new term, convenience yield? This is the extra economic value you get for having a physical thing right now, when it is needed the most. The best way to think about it is this. Imagine the value of having a tanker full of natural gas on hand during the coldest day of winter. That extra value, that immediate usefulness, that is its convenience yield.
So at this point, you might be thinking, wow, this carry thing sounds amazing. It's like a free lunch. You just collect dividends and yields. What could possibly go wrong? Well, as you can see, it is absolutely not free money. Let's talk about the danger we hinted at right at the start.
This right here is the fundamental trade-off. On one hand, you have your expected gain, that nice positive carry you're hoping to collect. But that gain is always at risk of being wiped out if the asset's price moves against you. Traders call this the spot drag. Think about it. If you earn 2% carry, but the asset's price drops by 5%, you've still lost 3%. The carry is a cushion, but it's not a guarantee.
And this brings us to a super important point. Carry strategies have something called negative skew. The absolute best way to think about this is that earning carry is like being an insurance company. Most of the time, you're just collecting small, steady checks, the premiums, day after day, week after week. But you are always living with the small but very real risk of a catastrophic event, a sudden market crash, that forces you to make a massive payout, wiping out years of those small profits in an instant. You're getting paid to take on that big, sudden risk.
So, given all that risk, how do professional traders actually use this powerful signal without getting blown up? Well, let's see how they turn this raw concept of carry into a real practical trading strategy.
It's really a three-step process. First, they measure the raw carry itself. They often do this by looking at the price difference between futures contracts, which kind of gives them a peek into the market's expectation for the future. Second, they annualize that number so they can compare apples to apples. And third, and this is the most important step of all, they adjust it for risk.
And this table shows you exactly why that risk adjustment step is so critical. If you just look at the raw numbers, the S&P 500 carry of 26 looks way better than crude oil 6.24, right? But, and this is a big but, when you divide by how volatile each asset is, the entire picture flips on its head. The risk-adjusted carry for oil is over 10 times stronger. Now that is the real signal that traders are looking for.
But even after you risk adjust, the signal isn't perfect. I mean, just look at these charts for the S&P 500 and crude oil. The raw carry data is incredibly noisy. It's jumping all over the place day to day, and all that chaos can create a ton of false alarms, tricking you into making bad trades.
So what's the solution to all that chaos? Well, it's actually pretty intuitive. You just smooth out the data. Traders will use tools like moving averages to filter out all that daily noise, and that helps them see the real, underlying trend in the carry signal that they're trying to capture.
Okay, so we've covered a lot of ground. Let's try to bring it all home. What's the one big idea you should walk away with after this deep dive into the world of carry?
When you boil it all down, it comes to this. Carry is not some magic formula for free money. It is quite simply the market's reward for taking on risk. It's a payment for being the insurance company. So the ultimate question for any investor isn't just, where's the positive carry? The real question, the one you have to ask yourself, is much more personal. Which risks are you willing to be paid to take?
Okay, let's dive right in. What if you could take two really powerful but totally opposite investment strategies and just click them together like Legos to build something way better than either one on its own? Well, that's exactly what we're going to explore today. How to build the ultimate financial strategy by combining trend following and carry trade it. So here's the game plan. First, we're going to meet our two clashing strategies. Then we'll figure out how on earth you can actually combine them, find that perfect sweet spot. And then, the fun part, look at the incredible results. And finally, we'll pull back the curtain on the secret sauce that makes it all work so well. All right, so let's get to the heart of it. We have two completely different philosophies here. And to make this super simple, just think of them as the surfer and the farmer. So on one side, you've got the trend follower. That's our surfer. This is what we call a divergent strategy. It thrives when things get crazy, when prices move away from the average. The surfer is always looking for those huge market waves to ride for as long as possible. And on the other side, we've got the carry trader, our farmer. This is a convergent strategy. It bets that things will stay calm and eventually return to normal. The farmer is all about stability, planting seeds and patiently collecting a small, steady income just as long as the weather's good. Now, both of these are powerful in their own right, but as you'll see, neither one is the complete picture. And this brings us to the big question, right? They seem like total opposites. One loves chaos, the other loves calm. But what if you could actually harness the strengths of both? What if you didn't have to pick a side? Well, it turns out you can combine them. And this is where we get to build something new with our, financial Legos. The real trick is finding a system that lets these completely different pieces actually click together. And the key that unlocks this whole thing is a concept called the scaled forecast. You can think of it like a universal translator for investing. It takes the unique signals from both the trend strategy and the carry strategy and converts them into one common risk-adjusted language. By putting everything on the exact same scale, we can finally compare apples and oranges, or in this case, our surfer and our farmer. And this is just the perfect analogy from the author Robert Carver. He says that this approach is just like building with Lego blocks. The scaled forecast is what turns each strategy into a standardized block. And because they all have the same connectors, you can suddenly snap a surfer block right onto a farmer block and start building something much bigger and much more stable. Okay, so we know we can combine them now, but what's the right recipe? How much of each Lego block do we use? Should it be 50-50 or something else entirely? That's what we need to figure out now, finding that perfect mix. So after running the numbers on a bunch of different combos, the author lands on this very specific allocation. A 60% weight goes to our surfer, the trend strategy, and a 40% weight goes to our farmer, the carry strategy. So why this exact split? Well, the data here tells a really clear story. This 60-40 split is the magic number. Just look at what happens as we move from 100% trend down to 60%. The Sharpe ratio, which is basically our measure of risk-adjusted return or bang for your buck, it actually goes up, and it peaks right there at that 60% mark. And at the exact same time, the average drawdown, which is the size of those scary dips in your portfolio, hits its lowest point. So this isn't just a guess, it's the data-driven sweet spot for getting the best returns with the smoothest possible ride. So, we've built our financial Lego set, we've got the perfect 60-40 mix, but does it actually hold up in the real world? This is the exciting part. Let's put this whole theory to the test and see what happens. And the results are, well, they're fantastic. In a head-to-head matchup, our combined strategy is the clear champion. It has the highest risk-adjusted return with a Sharpe ratio of 1.27 and the smallest average dip at just under 9%. It beats a simple buy-and-hold portfolio, it beats pure trend, and it beats pure carry. It's really the best of all worlds. And honestly, this one graph tells the whole story in a single picture. That black line, that's our combined strategy. Just look at how much smoother and more consistent that growth is over more than 40 years. When the other strategies are taking these huge, gut-wrenching dives, our combined portfolio has much shallower, much more manageable dips. It is just a much, much better ride. So all of this leads to the biggest and maybe most important question: why? Why is it so much better? Let's uncover the secret sauce here in our final section, the diversification magic.
No, seriously. How can mixing two pretty good strategies create something that isn't just a little better, but is exceptional? The answer is all about a really powerful type of diversification.
To measure this magic, we use this really clever metric called the Sharpe ratio, or SRR. Here's a simple way to think about it. It compares the performance of your entire basket of fruit to the average performance of just one piece of fruit inside it. A high SRR tells you that your mix is working wonders, that the basket itself is way, way better than just the sum of its parts.
So first, let's just look at the pure trend strategy by itself. Its Sharpe ratio is 4.96. Now, that's fantastic. That means just by diversifying across different markets with a trend strategy, you get a result that's almost 5 times better than the average trade you make.
Now for our farmer carry, the pure carry strategy. Its SRR is 4.10. Again, that's really strong. Diversification is obviously helping a ton here too. But you can see the magic is just a little bit less powerful than it is for the trend strategy.
But here it is. This is the big reveal. When we look at our combined strategy, the quality of the average individual trade is, well, it's pretty average. But the performance of the entire portfolio is a stunning 1.27, the best of the bunch. This gives us a massive Sharpe ratio of 4.70. And this is the secret. The magic isn't about picking better individual trades. It's that the farmer is quietly making money while the surfer is waiting for a wave, and the surfer is catching those huge waves when the farmer's fields are getting flooded. They perfectly cancel out each other's weaknesses.
So if you take one thing away from all this, let it be this. Real, powerful diversification isn't just about owning different stocks and bonds. It's about owning different sources of return. It's about combining the wave-riding surfer with the patient farmer to create a portfolio that's ready for any season.
And that leaves us with a really fascinating final thought. We've seen the incredible power of just clicking 2 of these Lego blocks together. It really makes you wonder, what other blocks are out there? And what kind of even more powerful, more resilient structures could we build next?
Welcome to The Explainer. You know that old saying, the trend is your friend? Well, today we're going to be data detectives and figure out when that friend might just turn on you. We're diving deep into why a super strong signal can sometimes be a total trap.
Yeah, let's just jump right in. I mean, this quote, it just nails that feeling, doesn't it? That sudden, brutal market reversal. One minute you think you're riding this perfect wave, and the next, bam, it crashes. If you've ever traded, you probably know exactly what that feels like. So that's what this explainer is all about. We're going to follow an incredible investigation from our source material that really tears apart these trend-following strategies. Think of it like a journey into the dark side of what look like the best, strongest signals in the market. And it all boils down to this one big question. I mean, common wisdom tells you, right? You see a massive trend, you go big. You take a huge position to cash in. But is that actually true? Is that really the right move? Or is that exact thinking what leads traders right into a trap? Okay, so to get to the bottom of this, the author of our source material didn't mess around. They analyzed a huge data set. We're talking 102 different financial instruments. They were hunting for a clear, undeniable link between how strong a trend looked and what actually happened next. You know, the real-world returns. The logic here is pretty straightforward, right? If a stronger forecast is a better forecast, you'd expect to see a nice, clean pattern. The stronger the signal gets, the higher the returns should be. Simple. Except that's not at all what they found when they first looked. And yeah, take a look. The raw data is just a blob, a total mess. It honestly looks more like a photo from the Hubble telescope than anything you'd use for trading. From this angle, you can't see a thing. There's absolutely no relationship visible here. But here is where things get really interesting. Watch what happens when they just change how they look at the data. They started grouping all those messy points into bins and just plotted the averages. And like magic, all that noise just melts away. And suddenly, a pattern appears. This is our first big clue, the first crack in the case. Okay, so now that we can actually see something, what does it tell us? Well, this new pattern has a pretty big secret hidden inside, especially when you look at the very edges, the strongest parts of the trend, the parts that are supposed to be the moneymakers. It turns out the data was screaming mean reversion, What's that? It's this powerful idea that after a really sharp, fast move in one direction, the market doesn't want to keep going. Nope, it's actually more likely to snap back, to reverse course completely. And this is the trap in a nutshell. For the fastest moving trends, a super strong negative forecast, a signal that screams sell, 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 was actually followed by, wait for it, a positive return. The market bounced back. So if you'd followed that strong signal, you'd have done the exact wrong thing. Ouch. Now, it gets a little more complicated when you look at different speeds. The medium speed trends, they actually behave pretty much like you'd expect. Nice and predictable. But look at the really slow, grinding trends. After a long, strong run-up, the market just seems to get tired. It runs out of gas and the returns just fizzle out. So what's the big takeaway here? That whole simple idea, stronger is better, it's just wrong. It's fundamentally flawed. The reality is, the relationship between trend strength and returns completely falls apart at the extremes. And the craziest part? The strongest forecasts are often the least reliable, the ones you should trust the least. So after uncovering this, the author could have just stopped, but they didn't. Instead, they decided to try and build a better mousetrap. They set out to engineer a smarter model that could actually handle these weird, dangerous quirks you see at the extremes. The goal was pretty cool, actually. They wanted to build a system with some self-awareness, a system that knows when to pump the brakes. So instead of just blindly chasing a trend that's going vertical, this new model would be smart enough to pull back, to reduce its position, because it's anticipating that snapback, or that exhaustion we just talked about. For those super fast trends, they came up with something called the double V adjustment. Now, I know the formula looks a little scary, but the idea is simple. It's built to deal with that mean reversion. Once a trend gets too strong, the model starts to back off, and if it gets really extreme, it does something crazy. It actually starts betting against the trend. Okay, now for these slower trends. The fix was a bit more chill. It's called the scale and cap. It doesn't do a full 180 and bet against the trend, but it does know to take its foot off the gas pedal a lot sooner. It's basically telling the system, hey, let's not get carried away here. This trend looks like it's getting tired. So let's be honest, this all sounds pretty genius, right? A super sophisticated, data-driven fix for a real problem. But here's the million-dollar question. Did it actually work? Did all this complexity pay off? Well, the results were, let's just say, surprising. It was an absolute disaster. Seriously. The double V fix for the fastest trend, it took a strategy that was making a little money and turned it into a money loser. It went from a positive 3.5% return to a negative 4.5%. And the trading costs, they exploded. They practically doubled. A total train wreck. All right, what about the fix for the slower trends? Well, it did a little better. I mean, it bumped up the raw return, and that's great. But when you look at the Sharpe ratio, which is a super important number that tells you if you're getting paid for the risk you're taking, it actually got a tiny bit worse. So yeah, you made more money, but you were taking on even more risk to get it. Not exactly a home run. So after all that, when they put all these fancy adjustments together into one big portfolio, what was the grand prize? The big improvement in the Sharpe ratio? It was plus 0.02. That's it. All that research, all that complexity, for a gain so small you could barely even measure it. Wow. And you don't have to take my word for it. This is the author's own brutally honest take. After all that brainpower, all that work designing this incredibly intricate system, they basically say, yeah, I wouldn't trade this. The tiny improvement just wasn't worth the massive headache of all that complexity. And that right there is the huge lesson from this whole detective story. It's this giant flashing warning sign about something called overfitting. That's the trap you fall into when you create a system that's so complex, so perfectly designed for the past, that it just completely falls apart in the real world. It really makes you stop and think about the trade-offs, doesn't it? You've got the complex fix on one hand. It's a black box, it's fragile, and the payoff is tiny. And on the other hand, you've got the simple strategy. It's tough, you can understand it, you can trust it, and you know what? It's good enough. And that really leaves us with one final thought. And this goes way beyond just trading. In your own world, in your own work, think about it. How often do we chase the super complex answer just because it feels smarter? when there's a simpler, more effective solution just sitting there, waiting for us. It's that constant tug of war, isn't it, between being clever and just being effective. All right, let's dive into something every trader thinks about: volatility. But what if I told you there's a right kind and a very, very wrong kind of volatility? Today, we're going to unpack what that actually means and how it can totally change the game. So this whole thing kicks off with a conversation. Picture this: a hedge fund trader, his fund is getting hammered, and a professor asks him this really simple question, basically saying, hey, wait a minute. And the trader's response is just perfect. It's cryptic, it's intriguing, and it's the entire reason we're here today. This one sentence just hangs in the air and makes you ask, what on earth is the wrong kind of volatility? Okay, to figure this out, we have to go a little deeper. We have to stop thinking about volatility as just markets moving a lot. Instead, we need to think about the character of those moves. Are they organized or are they just pure chaos? I love this analogy. Think of your trading strategy like a sailboat. Good volatility is that perfect, strong, steady wind at your back. It's predictable, it's powerful, and it pushes you right where you want to go. Bad volatility, on the other hand, that's a hurricane. The wind is howling, but it's coming from every direction at once. You're just getting tossed around, going nowhere, and probably taking on water. That, for a trend trader, is an absolute nightmare.
So, that's a nice story, right? Steady wind versus a storm. But the real question is, can you actually measure it? Can you look at the market and say, okay, we're officially in a storm now? Well, it turns out you can. And it all comes down to defining what we call market risk regimes.
The key metric for all this is something called relative volatility. Now, it sounds kind of technical, but the idea is incredibly simple. All it does is compare how choppy the market is right now to how choppy it's been on average for, say, the last decade. It's just a way of asking, is today's market action normal, or is something unusual happening?
And check this out. Here is that exact metric mapped out for the S&P 500. You see those insane spikes? They're not random. They line up perfectly with every major crisis you can think of. The '87 crash, the dot-com bubble bursting, the 2008 financial meltdown. These spikes, this is what that chaotic, bad volatility looks like on a chart.
So to turn this into a system that isn't just guesswork, the analysis follows a really simple three-step process. First, you take this volatility data from more than 100 different markets: stocks, bonds, currencies, you name it. Then, you throw all of it onto one big chart. And finally, you just slice it up. The quietest 25% of the time, that's your low volatility regime. The craziest, most chaotic 25%, that's your high regime.
And this is what all that data looks like when you put it together. You can see that, most of the time, things are pretty calm, that big hump over on the left. But what we're really interested in is that long, skinny tail way out on the right. By looking at all this data together, we can draw a line in the sand. High volatility isn't just a feeling anymore. It is, statistically, the top quarter of market chaos ever recorded. Okay, so we've done it. We've scientifically classified the market's mood. We can now say with confidence whether we're in a calm period or a chaotic one. And that allows us to ask the million-dollar question. How do trading strategies actually behave in these different environments? Because this is where things get really, really interesting. So, does this all actually matter for your bottom line? Let's look at two really common strategies. We've talked about trend following, and we'll also look at carry, which is basically a strategy of earning yield. How do these two hold up when we split their performance across our new volatility regimes? Let's look at the numbers.
All right, let's break this down. On the left, you've got your carry strategies. On the right, you've got trend following. The different shades of gray represent low, medium, and high volatility. Now, I want you to focus your eyes on the right side of the chart, and specifically on those darkest gray bars. That's our high volatility chaotic storm regime. And there it is. It just jumps off the page. In that high volatility regime, trend following strategies don't just go flat, they become consistent money losers. Look at those dark gray bars. They are all deep in the red. We found it. This right here, this is the wrong kind of volatility. The data proves it. When markets enter that state of pure chaos, traditional trend following just completely falls apart.
So we've pinpointed a major weakness, a critical flaw in a very popular strategy. But, finding the problem is only half the battle. The really innovative part comes next, building a systematic way to fix it.
And the solution is this really elegant idea called the volatility multiplier. Honestly, the best way to think of it is like a volume dial for your risk. The system is constantly listening to the market, and based on the volatility regime it detects, it automatically turns your risk exposure up or down. So here's how that volume dial works in practice. When the market is in that calm, steady, good volatility zone, our smooth sailing weather, the multiplier cranks up the volume. It doubles the position size to take advantage of the good times. But when that chaotic storm rolls in and we enter the bad volatility regime, it does the exact opposite. It slams the volume down, cutting the position size in half to protect you when the strategy is most likely to fail. And the results? They're pretty incredible. Just look at the numbers. The average annual return jumps from about 26.5% to 30%. But even more importantly, look at the Sharpe ratio. That's your return for every unit of risk you take, your bang for your buck. And that gets a huge boost. This simple, dynamic tweak makes the strategy both more profitable and way more efficient.
This chart really shows you the power of this over the long haul. That black line is our new, smarter volatility-adjusted strategy. You can just see it steadily and consistently pulling away from the original version over decades. And what's really happening here isn't one or two big wins. It's the power of compounding by playing better defense, by protecting the strategy from those big, painful losses during the chaotic times. So let's just quickly recap the big ideas here. First, and most importantly, not all volatility is created equal. Second, you can actually use data to classify the market's mood into these distinct risk regimes. Third, and this is the critical one, we've seen that trend following has a hidden Achilles heel. It breaks down in high volatility environments. And finally, the coolest part, once you understand that weakness, you can build a dynamic system to adapt to it and make your strategy more robust.
What this all proves is that there are these hidden rules or patterns in the market, and if you can find them, you can build smarter systems that adapt to them. It just makes you wonder, doesn't it? What other fundamental truths about how markets behave are just sitting there, waiting to be discovered?
All right, today we're diving into a really cool trading idea, Strategy 14. Think of it like this. We're going to look at a price trend, but we're going to break it down, find its hidden ingredients, and see if we can find a purer signal inside.
You know, when you look at a chart and you see that line going up or down, what are you really looking at? Is it just one thing? Well, this strategy says, hold on a second. And that's a really important question. What's actually under the hood? What are the different pieces that are making that price move?
And it turns out it's not just one thing at all. Especially when we're talking about futures markets, any price move is basically a mix of two totally separate forces. First, you've got the actual price change of the asset itself. We'll call that spot. And second, there's the return you get just for, holding the contract. That's what we call carry.
Okay, so this is the basic math behind it. That adjusted price change you see there, that's what most trend strategies are actually trading. But look closer at the formula. It's really just the spot price change plus the carry accrued. See, it's two different things, two totally separate streams of return, all bundled up into one single number.
And that's the big aha moment here. Most trend-following systems out there, they just trade that combined, adjusted price. Price goes up, they buy. Price goes down, they sell. Simple. They don't even try to pull apart those two different pieces we just talked about.
So this gets us to the heart of the problem. Think about it. If a price is going up just because the carry is really high and positive, is that really a trend? Is it the same thing as the actual asset going up in value? The whole idea here is that by mixing them, you might be accidentally double counting your bet on carry, and that could be muddying up what should be a really clean, pure trend signal.
Okay, so how do we clean up that signal? Well, the solution is pretty clever. We can mathematically pull out the pure trend by creating something called a synthetic spot price. Let's dig into how that actually works. The synthetic spot price is pretty much what it says on the tin. It's a price series that we build ourselves using just the futures data. The whole point is to surgically remove every single penny of return that came from carry. What you're left with is, hopefully, a much purer, cleaner signal of the asset's actual price movement. And the logic behind it? It's so simple, it's beautiful. We know the total price is just spot plus carry. So, if you want to find the pure spot price, what do? You just take the total price and subtract the carry. That's it. We've successfully unbundled the two signals.
And this chart, wow, this chart shows it perfectly. Let's look at the US 10-year bond future. That dark gray line, that's the adjusted price, what almost everyone trades.
Now see that solid black line? That's all the return that came from carry over time. So if you just mathematically subtract that black line from the dark gray line, you get the light gray line, and that's our synthetic spot price. Just look at it. It's way choppier, way less trendy. It turns out a huge chunk of what we thought was a trend in bonds was really just carry doing its thing.
Okay, so we did it. We've got our pure trend signal. So the next step is obvious, right? We trade it and we make a killing. Well, this is where things get really, really interesting.
This really is the big question, isn't it? We've done all this work to get this pure, clean spot signal to get rid of that contaminating carry. So does it actually work better on its own?
And the answer is a pretty clear no. It's kind of shocking, actually. This chart here shows the Sharpe ratio, risk-adjusted return for both strategies. The top line is the old school combined price trend, and that bottom line, that's our fancy new pure trend. And yeah, no matter how you slice it, at every single trend speed, the pure signal just performs worse, a lot worse.
So what on earth is going on here? Well, it's not the same across the board. For assets that have a ton of carry, like bonds or volatility, stripping it out just guts the strategy's performance. It turns out a lot of that so-called trend was the carry. But for things with low carry, like metals or equities, taking it out actually makes performance a little bit better. It seems like there, we really did just filter out some noise.
So, was this whole thing a waste of time? A total failure? Absolutely not. See, the real magic of the synthetic spot price isn't in replacing the old signal. It's about using it to build a much smarter portfolio. This is where the real solution lies.
Okay, so here's the key takeaway. We don't just chuck the carry signal in the trash. No way. What we've done is successfully unbundle the price into two clean, separate signals, pure trend and pure carry. And now that they're separate, we can treat them like two different tools in our toolbox and put them back together in a much more intelligent, deliberate way.
And the process for doing this is pretty simple, really. Step 1, you separate the signals. Step 2, you test out a bunch of different mixes to see how they perform together. And Step 3, you find that perfect new optimal blend that gives you exactly the kind of portfolio you're looking for.
And what they found is just fascinating. The original old school strategy was something like 60% trend and 40% carry. But when you use these new, pure, unbundled signals, the best mix is almost a perfect mirror image. Only 40% to the pure trend and 60% to the pure carry. It just goes to show how much carry was secretly hiding inside that old trend signal.
All right, let's put them head to head. The new blend, Strategy 14, its Sharpe ratio is a tiny bit lower, but check out what you get in return. The alpha, that pure uncorrelated return, is actually a bit higher. The beta, how much it moves with the market, is slashed almost in half. And the skew, which is huge for trend followers, it's that potential for those massive winning trades, is way, way better. What we've basically done is build a portfolio that's much more of a pure alpha machine with a lot less of that generic market risk.
So in the end, deciding which way to go, it's not just about which numbers look better on a spreadsheet. It really comes down to a fundamental choice about your own trading philosophy. Here's the choice you have to make. If you stick with the old adjusted price, you get this kind of natural built-in stop loss because the signal itself reflects how profitable you've been lately. But if you go with the separated signals, you get what the source calls a more honest picture of where your money is actually coming from. You know for a fact, am I making money because the spot price is moving my way, or am I just collecting carry? So let's wrap this up with the big takeaways. First, any futures trend has two hidden ingredients, spot and carry. Second, we can surgically remove the carry to create a pure trend signal. Third, that pure signal isn't great by itself, but it's an amazing tool for building a smarter portfolio. And finally, the choice between these methods is as much about your trading philosophy as it is about the stats.
And that brings us to the final question I want to leave you with. The next time you put on a trend trade, I want you to stop and ask yourself, do I really know where my returns are coming from? Am I trading the trend, or am I just trading the carry? Something to think about. Thanks for joining me. Okay, let's dive into something every quant trader thinks about. How do we build a better signal? The goal is always to take an idea that works and then, through some clever engineering, make it even more accurate. But what happens when all our smart improvements, don't actually improve a thing?
I mean, it seems like a simple, undeniable truth, doesn't it? A more accurate signal should lead to better results. If you can measure something more precisely, you ought to make better decisions. That's the basic idea we're going to put to the test today. But as you're about to see, the world of quant finance isn't always quite so straightforward.
So before we get too deep, let's make sure we're all on the same page with the key concept here, carry. Just think of it as a built-in tailwind, or maybe a headwind, that you get just for holding a futures position. If the futures curve is sloped in your favor, you can actually make money from carry, even if the price of the asset itself, whether it's corn or oil or a stock index, goes absolutely nowhere. It's a massive driver of returns in a ton of strategies. And right here is where the trouble starts. See, our standard way of measuring carry, it's not always perfect. In some situations, it's kind of like trying to measure a room with a ruler that shrinks and expands depending on the time of year. Yeah, you'll get a number, but it might not be telling you the real story.
The main culprit for this is seasonality. For things like stock indexes, you've got dividends that are paid out at really predictable times of the year. For agricultural stuff, weather creates obvious seasonal patterns. All these predictable effects create these bumps and wiggles in the futures curve that can totally fool our standard carry calculation, making us think the carry is great when it's actually weak, or the other way around.
Okay, so our signal is flawed. What are we going to do about it? Well, when you're faced with this problem, you've basically got two different roads you can go down to try and get a cleaner, more accurate picture of carry.
On the one hand, you've got the ideal solution, the direct path. Just compare the futures price to the actual live spot price. It's pure, it's simple, and it gives you the true carry. But the problem is that data isn't always easy to get your hands on. And that's what forces us down the second path, the clever but much more complex statistical workaround to try and mathematically scrub out those seasonal distortions. So you might be asking, well, why not just use the spot price all the time? And that's a great question. It's because it's not always that simple. For stock indexes, for currencies, yeah, it's pretty easy to get. For most commodities, it's usually there. But for bonds, oh man, it can be a huge headache to calculate. This data problem is the exact reason that clever mathematical workaround starts to look so tempting. And that brings us to the heart of our story today. We're about to walk through this very slick workaround. Seriously, this is a fascinating piece of financial engineering designed from the ground up to create what should be a theoretically perfect carry signal. Let's see how it's actually done. Okay, let's start with our problem child. Take a look at this. This is the raw, unadjusted carry signal for the Eurostock stock index. See those gigantic, spiky patterns that repeat over and over? That's not random market chaos. Nope, that is the predictable effect of dividend payments creating these massive but totally misleading seasonal patterns in our carry calculation. Our mission, should we choose to accept it, is to surgically remove them. So how do we even start? Well, first, the algorithm goes through the data year by year. As you can see with all these different colored lines, it's identifying and pulling out that repeating, predictable pattern, all that seasonal noise for each specific year. We're basically taking the signal apart piece by piece. Okay, now here comes the really crucial step. First, we take all those individual yearly patterns and we average them together. That gives us a single, typical seasonal pattern, which you see here as the solid black line. But here's the really slick part. The original carry calculation has this weird timing mismatch. It looks at the price difference between two futures contracts today, but that carry is actually earned over the next month. So to fix this, the algorithm computationally shifts that average pattern forward in time. That's the gray line. In theory, this perfectly aligns the seasonal noise with the exact period we're earning the carry. It's pretty clever. And voila! Here is the final product. We take our original raw signal and we subtract our special time-shifted seasonal component, and this is what we get. The noisy, spiky black line has been transformed into this much smoother, adjusted gray line. All of that complex math has given us what should be a more accurate, more reliable signal. On paper, it's a masterpiece.
So we've gone through all this trouble. We've deconstructed the signal, isolated the seasonality, averaged it, shifted it, and rebuilt it into this supposedly superior version. Now we get to the only question that really matters in trading. Did it actually make more money?
This is it, the big reveal. We have our original flawed signal, and we have our brand new mathematically pure signal. The new one is obviously more accurate, so it has to perform better, right? Let's find out. And the results are, worse in every single way. The original wrong signal returned 11.3% a year with a Sharpe ratio of 0.59.
Our sophisticated, adjusted, smarter signal, that dropped all the way down to 9.9% with a Sharpe of 0.51. All that work, all that complexity, it actually made the strategy significantly worse.
You know, I absolutely love the honesty here. The author of the strategy, Robert Carver, he doesn't try to spin it or make excuses. He just puts it out there, plain and simple. We have completely missed the ball. It's like we went to all this trouble and it was a total failure. That kind of intellectual honesty is so rare, and it's incredibly valuable.
So what do we learn from this spectacular failure? It turns out there's a really powerful lesson here about the allure of complexity and the critical difference between what's theoretically accurate and what's practically effective.
And this is the core idea. We can get so lost hunting for theoretical perfection that we accidentally engineer away our actual edge. The original signal, with all its flaws, was clearly capturing something valuable that our corrected signal just filtered out. It makes you wonder, maybe that seasonal noise wasn't just noise. Maybe it actually contained some predictive information about market sentiment or order flows that the simpler model was, by dumb luck, able to exploit.
So this brings us to the much more practical solution. Instead of all that fancy math, the author lays out this simple decision tree. For a lot of instruments, you don't need any adjustment at all. For others, if you can get the spot price, great. Just use that to calculate the true carry. And for those really tricky cases where you can't, the pragmatic advice is to either just stick with the flawed raw carry or use a much simpler adjustment, instead of chasing this perfect but ultimately worse solution.
And that leaves us with a final question to chew on. We're all searching for an edge, right? A smarter way to look at the markets. But this whole journey shows us that there's a really fine line between elegant complexity and just being counterproductively complicated. And knowing exactly where that line is, well, that might be the real secret to success after all.
All right, today we are jumping right into the allocation game. We're going to be looking at a portfolio that's built on two absolute powerhouses of systematic trading. You've got trend following, which, rides market momentum, and then you've got carry, which is all about profiting from those yield differences. Now, lots of traders combine them, but the real question, the billion-dollar question, is always this. How do you actually split your capital between them to get the best possible results? Okay, so let's get into it. The standard playbook, and it's a pretty sensible one, is to go with a simple 60% allocation to trend and 40% to carry. It's a solid, diversified place to start for sure, but the question that keeps every single strategist and trader up at night is always the same. Can we do better? Can we get a little more tactical than just setting it and forgetting it? And this right here, this shows you the problem perfectly. I mean, just look at the performance of trend and carry year by year. You see this really clear seesaw pattern. Like in 2017, trend just had a terrible year, while carry was doing fine. Then the very next year, bam, it completely flips. This is exactly why a fixed allocation might be leaving some serious performance on the table. And that really frames our core challenge. We're not just chasing bigger numbers. What we're really on a quest for is more consistent returns. The whole problem is figuring out how to design a smarter, more dynamic allocation model that can actually adapt as the markets shift and change. I mean, wouldn't that just be the ultimate edge? If we could just know, somehow, that trend was about to have a monster year, we could just go all in. Of course, we don't have a crystal ball, but maybe, just maybe, we can find the next best thing, a predictive signal that's hiding right there in the data. So let's put on our detective hats. This is the investigation phase. We're going to start digging through the numbers, hunting for a clue, any kind of reliable signal that can help us tilt the odds in our favor. And the main tool we're going to use in our investigation is something called autocorrelation. The easiest way to think about it is like momentum, but for the strategy itself. It's really just asking a simple question. Hey, if a strategy had a good run lately, does that make it more likely to have another good run? If the answer is yes, that's what we call positive autocorrelation. Performance tends to stick around. And here it is. This is our aha moment. So this chart shows the autocorrelation across a bunch of different time frames. You can see the shorter periods over on the left. They're pretty much just noise, right? But look all the way to the far right at that annual bar. Now we see a strong positive signal. That's the clue we've been looking for. So what does this actually tell us? It means that performance isn't just random from one year to the next. That positive signal we found suggests that a strategy that's done well over the last 12 months is statistically more likely to keep doing well. We've found our signal. Okay, so finding a signal is one thing, but actually putting it to work, that's a whole different ballgame.
let's move on and see how we can use this discovery to build a practical, dynamic allocation model. Now, the logic behind this model is actually super intuitive, and it breaks down into 3 really simple steps. First, every day we find the winner. We just subtract Carey's performance from Trent's. Easy enough. Second, we keep a running score of this relative performance over the past year. And third, we use that score to create a weight that automatically and dynamically shifts more capital to whichever strategy has been winning recently. Simple as that. And boom, this is what that model looks like in action. This chart shows the allocation to the trend strategy over decades. And notice, it's not just making these tiny little tweaks, it is making decisive shifts. I mean, sometimes it goes to 100% trend, and other times it drops to almost 0, which means it's effectively all in on Carey. This is a genuinely dynamic approach. So, the million-dollar question, did it actually work? Let's check out the back test. Compared to our fixed 60-40 split, our variable model, well, it improves the mean annual return, and it nudges the Sharpe ratio up a bit, from 1.27 to 1.33. Now, these are small improvements, but they're real. The one little catch is that the average drawdown gets slightly bigger. But hey, before we start celebrating and declaring victory on this whole factor timing thing, it's really important to bring in a voice of caution. This quote is from Cliff Asness of AQR, who's an absolute titan in the quant world. And he basically argues that investors should be super wary of getting too aggressive with timing. His advice is often just to find good strategies you believe in and stay diversified. It's a powerful reality check. And that little note of caution gets you thinking, is there maybe another way to do this? Instead of trying to time the entire portfolio, what if we could make a more targeted, kind of surgical refinement? Let's try to attack this problem from a completely different angle by looking at each asset class one by one. So when you slice the data by asset class, a pattern seems to pop right out. It looks like trend strategies work way better in commodities than in financial markets. But it turns out this is a statistical mirage. It's an illusion that's only there because our commodity data goes back much further into this kind of golden era for trend following. As soon as you adjust for that, the pattern just disappears. But after sifting through all that data and clearing out the noise, one thing remains that is not a mirage. There's one signal that stays robust and clear no matter how you slice the time period. And that signal is found within equities. And this is just staggering. I mean, look at this bar chart. It's comparing the performance, the Sharpe ratio, of trend versus Carey, but only within the equity asset class. Carey does okay, a Sharpe of 0.40, but trend, its Sharpe ratio is basically 0. It's nothing. The data is practically screaming at us that trend following just hasn't worked in equities. So this leads us to a totally different kind of solution. Instead of some complex dynamic timing model, what if we just make one simple permanent adjustment based on this really powerful insight? The new plan is this. We're going to slash the trend allocation from 60% way down to just 10%, but only for equities. Okay, now let's look at the results of this one single targeted change. The Sharpe ratio, it gets the exact same boost as our complex timing model, all the way up to 1.33. But check this out. The average drawdown actually improves. It gets smaller. And even better, look at the turnover, which is basically how much you're trading. It drops significantly. So we're getting the same upside with less risk and lower costs. That's a huge win. So where does this whole journey leave us? We've explored 2 very different ways to try and improve on our baseline strategy. Let's bring them both together and build our final trading plan. So here is the complete 2-part solution, combining both of our ideas. First, you can implement that dynamic timing model that adjusts the whole portfolio based on recent performance. Then, on top of that, you layer on the specific static rule just for equities, always keeping trend underweight in that one asset class. It's really a blend of a broad tactical approach with a very targeted, data-driven tweak. And that really brings us to the final thought here. We started with a simple 60-40 rule, and we found that one single surgical adjustment in just one tiny corner of the portfolio gave us significant improvements in risk and in cost. So the question I want to leave you with is this. If that's what we found hiding in plain sight over here, where else in your own strategies might similar powerful opportunities for optimization be lurking?
Welcome back. Today we're tackling something a little different. It's a trading strategy called normalized trend. Sounds a bit complicated, right? Well, the idea is to give you a whole new way of looking at the market. So let's just jump right in and unpack this.
So let me ask you something. Your current trading strategy, are you sure it's really seeing the whole picture? I mean, even the most popular, tried and true methods, they all have blind spots. What if there's a perspective you're missing, something that could give you a real edge?
Yeah, that's the thing, right? Relying on just one way to look at a trend, it's just plain risky. The author we're looking at today is a huge believer in diversification, but not just across different stocks or commodities. We're talking about diversifying the way you trade. So that's our mission today. Find a new tool to add to the old trading toolkit.
Okay, so how do we actually do that? Well, most trend-following strategies, they really lean on one specific tool. And look, it's a great tool, it's powerful. But you know the old saying, putting all your eggs in one basket? It can be a real problem.
And that tool is usually the exponentially weighted moving average crossover, or EWMAC for short. It's a classic for a reason. It's great at spotting trends. It makes sense. But here's the kicker. It's not the only game in town. Not by a long shot. There are other ways to do this, ways that might just catch trends the old EWMAC completely misses.
So to really get why we even need another method, we have to talk about what markets are really like. And to put it mildly, they're just chaotic.
And this quote from the source material, it just hits the nail on the head. 1 minute things are calm, and then, boom, everything explodes with activity. This constant switching back and forth between quiet and crazy, well, that creates a huge problem for anyone trying to analyze the data.
And that brings us to the core problem, right? How can you possibly compare a trend from a super quiet period to one from a crazy volatile period? It's just not an apples-to-apples comparison. It's kind of like comparing a runner's time on a flat track to their time running straight up a hill. It's meaningless unless you adjust for the terrain, right? We need a way to adjust for the market's terrain, its volatility.
And that is where this new idea comes in. This is the big innovation from the source material. It's a strategy called the normalized trend, and it's designed to solve exactly this problem.
And the core idea is actually pretty simple, which I love. Price normalization basically takes that wild, messy, up and down price history, and with a little bit of math, it irons it out. It transforms it into a new price series that has a much more consistent, predictable rhythm, day in, day out.
So how does it actually work? Well, it's a three-step process, pretty logical. First, you take the daily price change. Simple enough. Then, and this is the key part, you divide it by how volatile the market has been recently. And then you just add that adjusted number to yesterday's normalized price. You're basically building a new, smoother price history, piece by piece, day by day.
And wow, look at this. This chart shows you exactly what happens. That solid black line, that's the real S&P 500 price history. You see all the jagged peaks and valleys, right? The chaos. But look at that dashed line. That's the normalized price. It follows the same general direction, but it's so much smoother. It's like all that crazy, unpredictable volatility has just been tamed.
Okay, so the theory's cool, the chart looks amazing, but let's be real. Does it actually work? Does all this extra math actually make you more money? That's the million-dollar question, isn't it?
All right, let's put them head to head. In one corner, we've got the original, standard trend-following strategy, using regular old prices. And in the other corner, we have the exact same strategy, but this time it's running on our new, smoothed-out, normalized prices. Let's see what happens.
And here are the results. Okay, so look at the Sharpe ratio. That's your return for the risk you take. It's almost identical. I mean, 1.14 versus 1.15. The normalized trend does have slightly higher returns, but it also trades more. So honestly, at first glance, this kind of looks like a big nothing burger. It's a wash. But wait, this is the real shocker. When you actually compare the day-to-day returns of these two strategies, the correlation is 0.97. That is massive. For all practical purposes, these two things are moving in almost perfect lockstep. They're basically the same. So yeah, that leads to a pretty obvious question, doesn't it? If this new, fancy, more complicated strategy performs almost exactly the same as the simple, old one, why on earth would anyone bother doing all the extra work?
And right there, that's where the real magic of this strategy shows up. Because the point was never to replace the old strategy. The point is to combine it.
See, the author's logic is this. You can't really prove one is better than the other, right? And hey, they're not 100% correlated. They're only 97%. So the smartest move is to just trade both. You're adding another slightly different flavor, another perspective to your portfolio.
Okay, let's look at a real-world example. Here's a portfolio for WTI crude oil. Instead of just picking one trend strategy, you split the risk. You put 30% into the original trend, 30% into our new normalized trend, and then you put the other 40% into something else, like a carry strategy.
And check this out. If you combine carry with just the original trend, you get a Sharpe ratio of 1.27. Pretty good. But if you combine carry with both of them, it bumps up to 1.32. Now, I know, it's a small improvement, but it is an improvement, and you're getting that little extra boost without really adding any more risk. It's a diversification win.
So, at the end of the day, what's the takeaway? It's that classic trade-off, isn't it? On one hand, you're definitely adding more complexity to your system. But what you get in return is a small, but real, diversification benefit. You're using a strategy that's just different enough to make a difference in the long run.
And for an automated trader, the author's conclusion is pretty clear. The extra work is worth it. For a computer, a little more math is no big deal. And hey, even a tiny benefit from something that's 97% the same is still a benefit. So for them, it's a no-brainer. Run both. And that really leaves us with a big question to chew on, doesn't it? We've just seen how adding a new, highly correlated strategy can give you a small edge. But it makes you wonder, where do you draw the line? At what point does adding more and more slightly different rules stop being smart diversification and just start becoming noise?
All right, welcome back. Today we are diving into a really cool idea, something that's almost a philosophical question for traders. What if there was one single hidden trend that was secretly driving an entire asset class? You know, like all equities or all bonds, all moving to the beat of one invisible drum. And what if we could actually find that pure signal?
I mean, think about it. When you see the S&P 500 and, say, the Eurostoxx 50 both tanking on the same day, is that just a coincidence? Or are they both just different reflections of one much bigger underlying movement that's happening beneath the surface? Well, the author of our source material gives this idea a name, a latent trend. And latent here just means hidden or not yet developed. The theory is that the price you see for any individual stock index is really made up of two things: this pure hidden trend, and then a whole bunch of random noise that's unique to that specific index. So our goal? Filter out all that noise and just trade the pure signal.
So, how in the world do we find this hidden signal? Well, the author suggests something pretty clever. Instead of relying on standard indices like the MSCI World, which have their own weird biases baked in, we're going to build our own custom index from the ground up, and we'll only use the futures prices of the instruments we're actually trading.
It's basically a three-step recipe. First, we get every instrument onto a level playing field so they can be compared fairly. Second, we average all their daily wiggles into one single number for the day. And third, we just string those daily numbers together one after another to create our new, hopefully super smooth trend line. Let's see how that works.
Okay, this first formula might look a little intimidating, but the key idea is to create what's called a normalized price. All this really does is adjust each instrument's price for its own historical volatility. And that's absolutely crucial, because it means a really jumpy market like crude oil doesn't completely drown out a steadier, quieter one like government bonds.
And this next step? Conceptually, it's super simple. We just take all of those volatility-adjusted daily returns from every single instrument in an asset class. We're talking dozens of different bonds, for example, and we just average them. That's it. This gives us one number that represents the entire asset class's movement for that one day. And for the grand finale, we just add them up. Seriously, we start at 0, and then we just add that daily average return, day after day after day. This running total, this cumulative sum, becomes our brand new custom-built index price. This is the latent trend we've been hunting for.
So, we've gone through all that work. We've built our shiny new signal. Now for the million-dollar question, does it actually work? And you know what? When you first plot these custom indices, the results, well, they look incredible.
Just take a look at these charts. You can see these beautifully clear, smooth trends emerging from the noise. I mean, look at that equity line. You can perfectly spot the major bear markets in the early 2000s and again in 2008. These signals look so clean, so obvious. You'd think they would be incredibly easy to trade for a profit.
And the initial numbers seem to back this up, big time.
When we test a basic trend-following rule on this new signal, the median Sharpe ratio across all asset classes is 0.30. Now that's a really solid improvement over the original strategy. And check out equities. A Sharpe of 0.12 might not sound like a home run, but it's way, way better than the barely positive or even negative results we saw from other trend strategies on stocks.
Okay, so at this point, everything is looking fantastic. The signal is cleaner, the performance on individual instruments is better, so the logical conclusion is that this has to be a better way to trade a whole portfolio, right?
Well, you probably guessed it. Here comes the twist. And it's a real head-scratcher. A diversification paradox, where a signal that looks better on paper actually produces worse results when you put it all together. And this, right here, is the moment the champagne goes flat. Just look at this table. When we put everything together into a full portfolio, our new asset class trend strategy, it only gets a Sharpe ratio of 0.97. That's significantly worse than the older, noisier trend strategies, which were clocking in around 1.14.
So, what just happened? All that improvement we saw when we looked at each instrument one by one has completely vanished at the portfolio level. In fact, we've actually gone backwards. How is that even possible?
The answer, in one word, is diversification. Think about it. In the older strategies, every single instrument had its own slightly different trend signal. This meant you had massive diversification happening inside each asset class. But with our new strategy, every instrument in an asset class, all the equities for example, gets the exact same signal. They all go long together or they all go short together. We've effectively killed the diversification within each asset class. And it turns out that benefit was a much bigger deal than the benefit of having a slightly cleaner signal.
So does that mean this whole idea was a total bust, a failure? Not at all.
It just means this isn't a silver bullet replacement for everything else. Instead, it has its own very specific niche where it can be super valuable.
So, who should actually use this? Well, this approach makes a ton of sense if you have limited capital, right? If you can only afford to trade one or two equity indices, you are absolutely better off using a signal derived from the entire asset class. It's also specifically useful for asset classes like equities, where we saw it did perform better. And finally, it might have a place as just one ingredient in a much larger, more complicated portfolio. And that leads us to our final, really interesting question. What happens if we don't replace our old strategies, but instead we just add this new one into the mix? Can this seemingly flawed strategy actually make the whole portfolio better? Okay, now this final result is pretty fascinating. When we combine our original strategies with this new asset class trend, the Sharpe ratio basically stays the same, right around 1.31. So no real change there. But look at the alpha. It actually goes up. And this is really the key takeaway. Alpha is the return that has absolutely nothing to do with the overall market's movement. It's that pure, uncorrelated profit that so many traders are chasing. And by adding in this new, different type of trend signal, even with all its flaws, we were able to boost the portfolio's pure alpha to a solid 24%. And this quote from the author Robert Carver really just sums it all up perfectly. The ultimate goal isn't about finding one single perfect signal that beats everything else. It's about finding as many different uncorrelated signals as you can. Because each one, even if it's imperfect on its own, adds a unique perspective that can make the entire system stronger and more robust. And that leaves us with one final thought to chew on. We went through a massive amount of work here to build a new signal that, frankly, failed on its own. But it did provide a small, hard-won edge when we combined it with everything else. Which makes you wonder, in your own work, is that tiny little edge worth the mountain of complexity it sometimes takes to find it? That's something to think about. See you on the next one.
Welcome to The Explainer. So today we're going to dig into a trading strategy that, believe it or not, all starts with a fight in a bar. It's a story about two traders, two very different definitions of the same word, and a really powerful lesson about what makes a strategy, well, valuable. All right, so picture this. You've got two hedge fund managers, Charlotte and Eric, meeting up for a drink. Now, Charlotte, she's a traditional futures trader. Eric works for what's called an equity market neutral fund. And yeah, the friendly small talk doesn't last very long. So, Eric kicks things off by explaining his strategy. He's not just looking at a stock's price on its own. Nope, he's comparing it to the overall market index. If a stock is crushing the index, he's buying. Seems pretty logical, right? Well, not to Charlotte.
Charlotte is having none of it. For her, momentum is way simpler. An asset's price is going up, you buy it. Price is going down, you sell it. The index? Who cares? That's just noise. And this little disagreement, according to the source material, it actually leads to a bit of a scuffle.
So who's actually right here? This isn't just a simple mix-up. It points to a huge area of confusion in the trading world. It's really a classic case of two people using the exact same word but meaning two totally different things.
And here's the twist. They're both right. For traders, momentum is basically a homonym. Charlotte is talking about time series momentum. You might notice trend following. That's all about looking at an asset's own past performance. But Eric, he's talking about cross-sectional momentum, which is all about how an asset performs relative to its buddies. Two completely different ideas, one single word.
Okay, so for the rest of this explainer, we're going to dive deep into Eric's world, the world of cross-sectional momentum. Let's break down the mechanics of how you actually figure out if something is outperforming the pack.
The first thing you have to wrap your head around is this idea of relative price. This isn't about the raw dollar amount. By using what's called a normalized price, you're basically putting all the assets on the same scale, a level playing field, so you can make a fair comparison. The question it answers is this stock leading its sector or is it falling behind?
And the math behind it is actually super simple. You take the normalized price of your specific instrument, let's say it's the S&P 500, and you just subtract the normalized price of its entire asset class, all equities. If that number is positive, it's outperforming. If it's negative, it's underperforming. That's it.
And speaking of the S&P 500, here's what that concept looks like in the real world. The gray line is the S&P 500 itself. The black line is the broader equity asset class. But the dashed line at the bottom, that's the one you really want to watch. That's the relative price. When it's going up, the S&P 500 is beating the competition. When it's going down, it's lagging.
So, how do you turn that chart into an actual trading signal? Well, it boils down to these 3 steps. First, you calculate that relative price we just talked about. Second, you look at its average change over a certain period of time. And finally, you smooth out that data, usually with a moving average, to get a cleaner, more reliable forecast.
Okay, so we've got the theory, we've got the formula. But now for the big question. Does this thing actually make money? Well, if we look at the strategy all by itself, the results are, let's just say, a bit underwhelming.
So just look at these numbers. The Sharpe ratio, that's your risk-adjusted return, right? Pros are usually hoping for something around 1.0, or even higher. And these, they're not even close. The absolute best one barely gets to 0.36. Not exactly something to write home about.
And it looks even worse when you put it side by side with other trend strategies, the kind Charlotte would use. Look at that. They're pulling in Sharpe ratios around 1.0. And our cross-sectional strategy? When you put all its time friends together, you get a measly 0.34. It's getting crushed.
So this begs the obvious question. Why on earth would anyone use this strategy? The numbers look terrible. The returns are lower, the returns risk-adjusted are lower. In fact, the source material itself says it has absolutely no redeeming features. So what gives?
Because this is where the whole story flips on its head. It turns out the strategy's biggest flaw, the very thing that makes its performance look so mediocre, is actually its secret weapon. It's not about how it does on its own. It's about how it plays with others. It all comes down to one number, 0.31. So what is that? That's its average correlation with all those other high-flying trend strategies. And let me tell you, in the world of portfolio management, a low number like that is pure gold. See, low correlation means it's marching to the beat of its own drum. When other strategies are zigging, this one is zagging. It's finding its profits in different ways, at different times, and that creates a return stream that's completely unique.
And that is its superpower. It adds diversification because its wins aren't tied to the same things as trend following. It's always playing this relative game. Long one stock, short another, right inside the same category. It's a totally different source of returns. And get this, its correlation with another big strategy, carry, is literally 0. It's a total oddball. So we're not talking about a star quarterback here. We're talking about that special teams player that just makes the entire team better. So what actually happens when we add this underdog to a portfolio of already winning strategies?
Okay, now check this out. When we add cross-sectional momentum into the mix, the average return actually dips a little bit. And the Sharpe ratio, it basically stays the same, maybe even ticks down a tiny bit. So you're thinking, what's the point? But then, look at that last row, average drawdown. That measures the painful dips your portfolio takes, and that number gets better. The portfolio becomes tougher, more resilient.
The author of the source material, Robert Carver, says it best. He basically says, look, I'd rather have a little more diversification, even if it costs me a tiny bit on the back-tested Sharpe ratio. Why? Because diversification is something you can actually count on. Future returns, not so much.
So the big takeaway here is that you can't just judge a strategy by looking at its stats in a vacuum. Some players aren't there to score all the points. They're there to make the entire team stronger, more stable, and ready to handle whatever the market throws at it.
And it really leaves us with a final question that goes way beyond just trading. When you're building anything, a portfolio, a company, a project team, are you just trying to collect a bunch of individual superstars, or are you trying to build the best possible team? Today, we're diving into a trading strategy called cross-sectional carry. Now, I know, the name sounds a bit technical, but stick with me because it has this totally fascinating and honestly counterintuitive secret about what it really takes to build a stronger investment portfolio.
So here's the central puzzle we're going to solve today. How on earth can a strategy that, by all accounts, looks worse on paper actually make your entire portfolio better? I mean, it just doesn't seem to make any sense, right? Well, the answer reveals a really powerful lesson about investing.
Okay, first things first. What even is carry? Well, in simple terms, a carry trade is just a bet that you can profit from an asset's yield, kind of like earning interest. But, you know, these simple bets can be pretty risky. The strategy we're looking at today takes a much smarter approach, one that tries to shield us from some of that nasty downside.
Let's think about it with an analogy. Standard or directional carry is like betting on a star athlete to win the race. It's a simple, direct bet on them winning. Cross-sectional carry, on the other hand, is way more subtle. It's like betting that same star athlete will perform better than the average of all their teammates. You see the shift? We're not focused on the outright win anymore, but on their relative performance.
So why bother with this extra step? Well, it's all about hedging your bets. A standard carry strategy can sometimes have what's known as poor skew, and what that means is you get these strings of small gains and then wham, a massive sudden loss out of nowhere. By focusing on relative performance, the goal is to smooth out those bumps and build a strategy with a much healthier risk profile. It's pure risk management.
Okay, so how do we actually do this? How do we calculate it? Well, it turns out it's a pretty straightforward three-step process that takes a standard carry forecast and morphs it into this relative or cross-sectional one.
First, you just start with the raw carry forecast for whatever instrument you're looking at. Next, to kind of cut through all the market noise, we smooth it out using something called a 90-day EWMA. Don't worry about the acronym, just think of it as a weighted average that pays more attention to recent prices. And then finally, and this is the absolute key, we subtract the median forecast of all its peers in the same asset class. What's left over is its true relative value.
So, step one is as basic as it gets. We calculate the standard carry forecast. This is our baseline, our starting point for pretty much any carry strategy. Then, in step two, we bring in that 90-day EWMA we were just talking about. The whole goal here is just to get a signal that's less choppy and more stable. It really helps us focus on the underlying trend instead of getting whipsawed by every little daily market jitter. And here's where the magic happens. Step three. We take our nice, smooth forecast for our one instrument, and we literally just subtract the median forecast for its entire peer group. This is the move that isolates its relative strength or weakness. And that right there is our cross-sectional carry forecast. Let's look at a real example so this clicks. Here we've got US 2-year bonds. That gray line, that's its own smoothed carry, and you can see it's all over the place. The solid black line, that's the median for all the other bond futures, its teammates, so to speak. Our final signal, that dotted line, is just the difference between those two. That's the relative value we've been looking for.
Okay, so it's a clever idea. It's mathematically sound, it makes intuitive sense. But here's the million-dollar question. Does it actually perform well as a standalone strategy? The answer? Well, it might just surprise you.
When we look at the Sharpe ratio, which is, a key measure of how much return you're getting for the risk you're taking, the results are, well, they're stark. The standard strategy has a very respectable Sharpe of 0.94. Our new fancy cross-sectional version, a measly 0.31. Ouch. On its own, this strategy looks like a pretty serious downgrade.
In fact, according to the source material, the overall Sharpe ratio for this strategy is really disappointing. It seems like our clever attempt to hedge out risk has also managed to hedge out a huge chunk of the returns. So, is the strategy a total failure? Well, not so fast.
And this brings us right to the heart of the whole thing. The real value of cross-sectional carry. It isn't as a solo act. Its real power is only revealed when you combine it with other strategies. It has a hidden superpower.
And the entire secret comes down to this one number, 0.31. That is the correlation between the original strategy and our new one. Now, in portfolio management, a low correlation like that is like finding gold. It means the two strategies don't move in lockstep. One can be zigging while the other is zagging. That, my friends, is the secret sauce. Now, just watch what happens when we combine them. We make a portfolio that's 70% of the good strategy and 30% of our worse one. The Sharpe ratio, it barely even moves, still really solid. But look at the average drawdown. The typical painful loss from a peak, it plummets from over 18% down to just 15%. We just made the portfolio way more resilient by adding a weaker ingredient. And this is our big aha moment. By adding a strategy that was, objectively worse all by itself, we made the combined portfolio better. Its value wasn't in its own returns, it was in diversification and risk reduction. This is a perfect real-world example of modern portfolio theory in action. And this effect just layers on beautifully. Say you start with a trend-following strategy, you add some directional carry, and yep, you get a nice bump in your Sharpe ratio. But then, if you sprinkle in our supposedly worse cross-sectional carry on top of that, it still improves the overall result. Every diversifying piece adds another layer of armor to your portfolio. This whole exercise really leads us to a much bigger, more fundamental question for anyone trying to build a trading system. Where should you focus your energy? On finding more and more trading rules, or on finding more instruments to trade? Robert Carver, the author of our source material, he puts it really bluntly. He says, and I quote, "You will get a larger benefit from adding instruments to your portfolio than from adding new trading rules." And the reason for that is actually pretty simple. Different instruments, like stocks, bonds, commodities, they just tend to have naturally lower correlations to each other. It's way more powerful to add a whole new, uncorrelated market to your portfolio than it is to just add a slightly different way to trade a market you're already in. Now, of course, there are exceptions to the rule. If you've got limited capital and just can't afford to trade dozens of different markets, then yeah, adding more trading rules is a great way to try and squeeze out better performance. Same thing is true if you're a massive trader who has already maxed out all the available instruments. For you, new rules are the next frontier. So this leaves us with a final thought to chew on. It's so easy to get caught up chasing the next perfect trading rule. But as we've just seen, sometimes the most valuable player isn't the star athlete, but the teammate that makes the entire team stronger. The real goal isn't finding one perfect rule. It's building the most resilient portfolio possible. Thanks for joining this explainer. Breakout trading. You've probably heard of it, right? It's this super appealing idea that you can catch a huge price move right as it's taking off. But what if the way most people actually do it is more like art, or maybe even guesswork, than actual science? Well, today we're going to pull this whole concept apart and rebuild it from scratch, using cold, hard data. And this is a popular idea. Just go to Google and type in breakout trading. You'll get back over 600,000 results. To put that in perspective, that's way more than you'd get for trend following or carry trading. So yeah, people are clearly fascinated by this. And this really gets to the heart of what we're talking about today. We're going to challenge all those common, gut feel methods and ask a simple question. Can we build a systematic, scientific rule that actually has an edge? And as you're about to see, the answer is a big yes. So here's our game plan. We'll start by looking at the breakout puzzle itself. Then we'll build a scientific price range. After that, we'll turn it into a real forecast. Figure out the best speed to run it at, combine those speeds, and finally, see how it all plugs into a bigger trading system. All right, first up, let's really dig into this breakout puzzle. The idea of a price just smashing through some kind of resistance level, it's just so intuitive, right? It feels like you're right there at the beginning of something big. The problem is how it's usually done can be, let's just say, a little fuzzy.
The author of our source material here really doesn't pull any punches. The problem isn't the idea of a breakout. It's the reliance on what he calls mumbo-jumbo. Just drawing lines on a chart based on a feeling or using these so-called magic numbers. It's just not repeatable. It's not scientific. So we obviously need a much better way.
So let's start building that better way. The very first step is to just toss out all that subjective chart drawing. We're going to replace it with a dead simple, mathematical, and totally objective definition of what a price range actually is.
And here it is. It's so beautifully simple, isn't it? A range is just the highest high and the lowest low that a price has hit over a specific number of past days. We'll just call that number H. That's it. No magic, no interpretation, just the data.
And what's awesome is how simple the math is. I mean, this is all we need. We just need to tell the computer, hey, look back over the last H days and tell me the highest price and the lowest price. That's it. That's our scientific range.
Now check this out. This chart shows it all in action. We're looking at crude oil prices. See those gray lines on the top and bottom? That's our scientific 320-day range. You can see the price just bouncing around inside that channel for years. And then, boom, look at late 2014. It just falls right through the floor. That, my friends, is a real data-driven breakout signal.
Okay, so we've defined our range. That's a huge step. But just having a range isn't a trading signal, right? So the next big step is to turn the price's position inside that range into a continuous forecast that can actually tell us what to do. And it's basically a three-step recipe. First, we figure out exactly where the current price is sitting within its range. Second, we scale that number so it goes from -20, which is super bearish, to +20, which is super bullish. And third, and this is super important, we smooth the whole thing out to get rid of all the random distracting noise.
Now here's the formula that does all that work. It might look a little complicated, but it's not. It just takes the current price, figures out how far it is from the middle of the range, and then scales it from -20 to +20. And then we wrap that whole thing in what's called an exponentially weighted moving average, or EWMA. All that does is smooth out the wrinkles.
So why even bother smoothing? Well, this chart says it all. That dark, jagged line, that's the raw forecast. Look at it, it's just a mess. It's all over the place. Trying to trade that would be insane and super expensive. But the lighter, smoother line, that's our final signal. It tells you the same basic story, but in a way you can actually use.
So it really all comes down to this simple trade-off. A raw signal is super noisy, which means you'd be trading like a maniac, and that leads to really high costs. But if we smooth it out, we get a nice, stable signal that cuts those costs way down. And the best part? The research shows we can do this without really hurting the strategy's performance. It's a win-win.
Okay, so let's go back to that H number, the look-back period for our range. It turns out there's no one single magic number that's perfect. The really cool thing is we can run this whole strategy at different speeds just by changing that number, from something really short-term to something really long-term.
I love this analogy. Think of it like this. A short look back, say 10 days, is like using binoculars. You're reacting to every little move that happens right now. A long look back, like 320 days, is like a telescope. You're looking for breaks from really long established patterns. The paper we're looking at actually tests 6 different speeds: 10, 20, 40, 80, 160, and 320 days.
And this table shows us a super clear trade-off. Just look at the fastest one, breakout 10. The trading costs are a massive 8.6%. That just eats up all the potential profit. But as we slow things down, say to breakout 80, the return gets much stronger, and the costs drop all the way down to just 1.4%.
So, because it has that really nice balance of good returns and low costs, the author says that if he could only pick one, he'd go with the 80-day version. But, and this is the magic of systematic trading, we don't have to pick just one.
And that brings us to the power of combination. Instead of trying to hunt for the one perfect speed, we can actually combine the signals from all 6 of those different horizons, and what we get is a single forecast that's way more diversified and way more robust.
The process for combining them is also really systematic. First, you only include the speeds that are actually cheap enough to trade in a given market. Then, you just average the forecast together. Nice and simple. And finally, you apply a little multiplier that accounts for the fact that you're getting all these great diversification benefits. So that takes us to our final strategy. This powerful combined breakout rule that we've built, well, it doesn't have to exist all by itself. It's what's known as a divergent strategy, kind of like trend following, which means it bets that big price moves will keep going. We can combine that with other totally different trading styles to build a really well-rounded portfolio.
And this chart here shows what that final mix looks like. The author suggests a portfolio that's 40% convergent strategies, things like carry, which bet on prices coming back to normal, and 60% divergent strategies. And that 60% is split right down the middle. 30% to a classic trend-following rule, and the other 30% to our brand new scientific breakout rule.
So what's the big payoff for all this work? Well, if we look at the Sharpe ratio, which is just a measure of risk-adjusted return, adding our new breakout strategy gives us a modest but definitely positive boost. It lifts the whole system from a 1.27 up to a 1.29. The big takeaway here is that even though trend and breakout are pretty similar, adding another well-built strategy can still make the whole system better.
And that really leaves us with one final thought to chew on. This whole process seems to suggest that the holy grail of trading isn't about finding one single, perfect, magical rule. Maybe the real goal is to patiently build a whole system, a collection of good, well-researched, and diversified strategies that's truly resilient for the long haul.
All right, today we're tackling something that sounds completely bonkers, a concept I'm calling financial alchemy. We're going to explore how a trading strategy that actually loses money year after year can somehow make your entire investment portfolio richer and stronger. Yeah, it sounds impossible, so let's break down how this financial magic actually works.
So let's just get right to it. The central puzzle of the day. Is it really possible for a trading strategy that is a proven loser on its own to somehow improve your overall portfolio? I mean, it flies in the face of common sense, right? But the answer, believe it or not, is yes. And drawing on some fascinating work by quantitative analyst Robert Carver, we're going to see exactly how.
Okay, so to really get our heads around this weird idea, we've got to start with something familiar, a concept most investors already know and probably love, the classic idea of value investing. At its heart, value investing is the simple, deeply satisfying idea of buy low, sell high. You know the drill. You hunt for assets, usually stocks, that seem like they're on sale, that are cheap compared to what they should be worth. You snap them up and then you just wait. You wait for the rest of the market to catch on and for the price to climb back up. It's intuitive, it feels smart, but man, does it require patience.
This does a perfect job of showing how value investing stacks up against its total opposite, trend following. Value is all about that patient buy low, sell high game played out over years. Trend following? That's about buy high and sell higher. You're jumping on an already moving train, which can feel completely wrong. They operate on different timelines, and honestly, they require totally different mindsets. But here's where the traditional approach just hits a brick wall. This buy low idea works great for stocks. But how in the world do you figure out the value of something that doesn't have earnings, like a commodity, like corn, or a cryptocurrency like Bitcoin? And that's the core of the problem, isn't it? You can look up the price-to-earnings ratio for a company like Apple in about 5 seconds. But what's the PE ratio of corn? What are the intrinsic earnings of Bitcoin? The tools everyone uses for value investing they don't work here. So we need a whole new way to think about value.
And this brings us to a really elegant solution. Instead of getting hung up on accounting numbers, you just redefine value based on how prices behave. You frame it as a bet on a very, very slow process called mean reversion. It's this powerful tendency for things that have gone way up or way down to eventually drift back towards the average. So how do you actually do that? Well, it kind of breaks down into 4 steps. First, you see how an asset is doing compared to everything else like it. Then, you look at that performance over a super long time, in this case 5 years. Now, step 3 is the key move. You bet on a total flip. You buy the stuff that's been doing poorly, and you bet against the stuff that's been soaring. And finally, you smooth it all out so you're not trading like a maniac. Now, for anyone who likes to see what's under the hood, here's the actual math. Don't worry, we're not going to have a quiz. The only thing you need to see here is that the forecast is basically the opposite of how something has performed over the last 5 years. You're literally betting that today's winners will be tomorrow's losers, and today's losers will be tomorrow's winners.
Okay, so we have this clever, redefined value strategy. The theory is sound, the logic is clean, but here comes the billion-dollar question. Does it actually make any money? Well, Robert Carver, the author of this whole idea, gives us a pretty big heads up. He says that because this all happens so slowly, you should never expect amazing performance. And boy, let me tell you, that might just be the understatement of the year. And here is the first gut punch. On its own, after all the costs are factored in, this strategy has an average annual return of -1%. That's right, it doesn't make money.
It actively loses money.
And if you thought that was bad, it gets worse. The Sharpe ratio, which is a fancy way of measuring your return for the amount of risk you take on, is also negative. This is the textbook definition of a bad strategy. It means you are taking risks and actively getting punished for it. So, case closed, right? This thing is useless. Well, not so fast. Because this is the exact moment where the story takes a wild turn. This is where we unlock that financial alchemy we talked about at the very beginning. You see, the secret power of this money-losing strategy has nothing to do with its performance. It's all about something else, correlation. Or to be more precise, its lack of correlation. The ups and downs of this value strategy just don't move in sync with other common strategies. It zigs when everything else zags.
And this gets to one of the most powerful rules in all of finance. Even a strategy that's a dud on its own can make your whole portfolio better if it zigs when your other stuff zags. It acts like a shock absorber, a stabilizer that just smooths out the entire ride.
And look at this. The proof is right here in the numbers. On the left, you've got strategy A, a portfolio with two great strategies, trend and carry. It makes a fantastic return with a really solid Sharpe ratio of 1.27. Now look at strategy B. The only thing we did was add a little bit of our losing value strategy. And what happened? The average return actually went up, and more importantly, the risk-adjusted return, the Sharpe ratio, got better. The portfolio literally became stronger. This is the financial alchemy. This is the magic trick. We took an ingredient that, by itself, is junk. We mixed it into the pot, and the final potion, the whole portfolio, actually got better. It's an incredible result that comes purely from the power of diversification. And how much of this losing strategy did it take to work this magic? You might think a lot, right? Nope. Look at this chart. Just a tiny 5% sliver. The heavy lifting is still being done by trend and carry. But that little 5% slice of our weird value strategy was enough to lift the performance of the whole thing. So after this wild ride through a totally counterintuitive idea, what's the final verdict? What's the big lesson we're supposed to take away from all this?
Well, it really boils down to a few key ideas. First, looking at a strategy's performance in isolation can be totally misleading. Second, low correlation is basically a superpower in the world of investing. Having a small piece of something that zigs when everything else zags is incredibly powerful. And that leads to the biggest point of all. Great investing isn't about just picking individual winners. It's about building a tough, resilient system where all the parts work together, even the parts that look like losers on their own. And that kind of leaves us with one final question to chew on. And this applies to way more than just money. So what are the overlooked, maybe even losing ideas in your own world, in your job, in your projects, that might actually hold some hidden, diversifying value? The things that could make the whole system stronger if you just looked at them in a different way. It's a powerful thought. Thanks for tuning in.
All right, welcome back. Today, we're going to break down a really clever trading strategy, and it tackles a huge problem by borrowing an idea, believe it or not, straight from your high school physics class. It's all about figuring out when a trend is about to run out of gas.
So let's kick things off with the #1 frustration for, well, pretty much anyone who follows market trends. I mean, have you ever felt this? You're just constantly one step behind. You see a trend starting to take off, but by the time your system finally says go, you've already missed the best part of the move. And what's worse, when the party's over, you're the last one to leave. So why does this keep happening?
Well, it all comes down to this. The very nature of waiting for a trend to prove itself means you're always reacting to what's already happened. By the time a trend is obvious enough for your rules to finally catch on, you're late to the game. And when it flips, you're left holding the bag while the price moves against you. It's this fundamental built-in lag.
Okay, so let's really dig into this idea, because this lag, it's at the absolute heart of the problem we're trying to solve today. You can think of it like a double-edged sword that cuts into your profits on both the way in and the way out.
So you're basically facing two big dilemmas. First, the rocket's already blasting off, but your system, it's still on the launch pad, waiting for, a dozen confirmations. And second, the rocket runs out of fuel and starts plummeting back to Earth, but your system hasn't even gotten the memo yet. Now, the obvious thought is, well, I'll just make my rules faster. But the source material is really clear on this. Just trying to speed things up usually leads to a ton of false starts and really expensive mistakes. It's not the answer.
And this is where it gets really interesting. Instead of just trying to put a bigger engine on the same old car, the
the source material suggests we should be measuring something totally different, something borrowed directly from physics. I want you to think about it like this. If a price trend is like a car's velocity, its speed and its direction, then what we really need to know is whether that car is stepping on the gas or hitting the brakes. And in physics, what's that called? It's acceleration. So we're not just looking at the trend itself, we're going to look at the rate of change of that trend.
And this right here, this is the key insight. This is the aha moment. By measuring this rate of change, this acceleration, we might just get an early warning that a trend is losing its juice long before it actually turns around.
So how do we actually measure this? Okay, so you see this formula on the screen, and it might look a little intimidating, right? But honestly, the idea behind it is super simple. All you're really doing is taking today's trend forecast and subtracting the forecast from a little while ago. That's it. The result is just one number that tells you, plain and simple, is the trend speeding up or is it hitting the brakes? And what this does is it gives us this incredible new layer of information. It breaks the world down into 4 scenarios. So if a trend is positive and the acceleration is also positive, hey, the bulls are in charge and they're getting stronger. But what if the trend is still positive, but the acceleration suddenly turns negative? That, my friends, is our canary in the coal mine. It's that critical early warning that the trend is running out of steam. And of course, the same exact logic works for downtrends. Okay, so let's make this real. Let's put this idea to the test in the wild. And we're going to look at one of the most volatile, craziest markets out there, Bitcoin futures, during that massive run-up in late 2020 and early 2021. So here's the chart. I mean, just look at this. Bitcoin went on this absolutely insane run, climbing from under $20,000 to over $60,000. But then, right there in April 2021, it all peaked and started to reverse hard. This is the perfect test case for our idea. Now, focus on that dark gray line. That's your typical standard trend-following signal. And just notice how it stays positive. It's still screaming buy well into May and June, long after the price had already peaked and was in a free fall. That is the costly lag we've been talking about, right there in action. But now, shift your eyes to that light gray line. That's our acceleration forecast. Do you see it? It peaks and turns negative way back in April, weeks, literally weeks, before the standard trend signal even flinched. That is your early warning. That's the signal telling you the upward momentum is fading and the trend might be over.
Okay, so it's super important to understand this next part. While this acceleration signal is an amazing early warning system, it's not necessarily a better strategy all by itself. It's real magic. Its true power comes from the fact that it just behaves very differently from the standard stuff.
And if you just look at the raw numbers, a standalone acceleration strategy actually has a lower risk-adjusted return, what we call a Sharpe ratio, than the good old-fashioned trend rules. So this isn't about throwing out our old strategy. It's about adding a powerful new and very different tool to our toolbox.
So if it's not a better standalone strategy, where's the magic? Well, it's right here in this chart. We're looking at something called beta, which is just a fancy way of saying how much does this strategy move in lockstep with the overall market? And a lower number means it's more independent. The standard trend strategy has a beta of 0.43, but acceleration, it's just 0.11. It's marching to the absolute beat of its own drum. And for diversification, that is exactly what you want to see. And this quote from the author just hits the nail on the head. Low correlation is basically the holy grail when you're building a portfolio. It means this new strategy is doing something genuinely unique. It's this amazing tool for diversification because it's going to zig when your other strategies zag, and that helps smooth out the ride.
So what actually happens when we take this unique diversifying tool and add it to a more traditional portfolio? Well, this is where the payoff really shines.
First, let's start with a baseline. Let's imagine we have a pretty solid portfolio that combines 2 well-known strategies, trend, which we've been talking about, and another one called carry. This is our starting point.
And the performance of this baseline portfolio, it's pretty solid. It has a Sharpe ratio, again, our measure of return versus risk, of 1.27. That's a very respectable number.
Okay, now for the moment of truth. We're going to take that exact same portfolio and we're simply going to add our new acceleration strategy into the mix.
And check this out. The Sharpe ratio ticks up to 1.29. Now, it's not a giant, earth-shattering leap, but it's a clear, definite improvement. Just by adding a strategy that does its own thing, the entire portfolio becomes more efficient.
And it's not just about that one number. The benefits actually go way deeper. The portfolio's drawdown, those painful dips from a high point, it actually gets smaller. And its alpha, which is basically the return you get from skill, it goes up. So even with a tiny increase in costs, the trade-off is absolutely worth it. The whole system just becomes more robust.
So what's the big idea here? In just about any field you can think of, most people are watching the velocity, the obvious, visible trend that everyone sees. But the real edge, the real insight, often comes from measuring the acceleration, that rate of change that signals a turning point before anybody else even notices. So it really leaves you with this question. What's the obvious trend that everyone in your world is obsessed with? And what's the acceleration, the rate of change that they're all ignoring?
Today, we're going to do something a little different, something really practical. We're going to take a simple observation about how people behave in markets and walk step by step through the process of turning it into a full-blown quantitative trading strategy. So let's get right into it. First off, let me ask you a question, because it really gets to the heart of what we're talking about today. Why do we love a long shot? Seriously, think about it. People will line up around the block to buy lottery tickets. They'll pile money into those moonshot stocks or bet on the total underdog. There's this really powerful human bias at play here, and that bias, well, that's where an opportunity starts to take shape. And the answer to that puzzle, the reason we're all drawn to that long shot, can be explained by a statistical concept called skew. It's kind of the hidden force that makes these bets so tempting. And believe it or not, it's going to be the foundation for the entire strategy we're about to build. So what exactly is skew? Well, the simple way to think about it is that it's a measure of lopsidedness. A lottery ticket? That has massive positive skew. You have a super high chance of a small known loss, the cost of the ticket. But you also have a tiny, teeny, tiny chance of a life-changing gain. And here's the crucial part. People are almost always willing to overpay for that tiny chance. We systematically overvalue positive skew. And that leads us directly to our big idea, our core hypothesis. If the market is constantly overpaying for assets with positive skew, those lottery tickets, then does that mean there might be a premium, a reward for anyone willing to do the complete opposite? Can we actually get paid to hold assets with negative skew? The kind with frequent small gains but a small chance of a big loss? That's the idea we're going to put to the test. Okay, but a good idea isn't a strategy, right? It's just a starting point. To build a system we can actually trade, we have to turn this cool qualitative concept into a hard, quantifiable number. We need a real signal. And boom, right away, we hit our first major hurdle. What you're looking at here is a raw 3-month rolling calculation of skew for VIX futures. Just look at those insane jumps. In late March, one single day's big move sends the signal into a nosedive. Then, come mid-June, when that one data point finally drops out of the window, it violently snaps right back up. I mean, come on, this is not a stable signal you can rely on. So the problem is crystal clear. A raw skew calculation is just way too noisy. It's super sensitive to one-off outliers, and the signal can just flip on a dime because an old data point fell off the back. You just can't build a reliable, stable trading strategy on a foundation that's this shaky. It's just not going to work. All right, so this is where the real engineering comes into play. We have to take this raw, messy signal and basically forge it into something stronger, something more robust and actually usable. We need a disciplined process to reinforce the structure of our idea. And we do that in 3 key steps. First, we just lengthen the window. We calculate skew over longer periods, like 60, 120, even 240 days, to make any single day's return less important. Second, we smooth that signal out using a moving average, which really helps dampen the wild swings. And finally, we scale and cap the result. That just makes it possible to compare signals across totally different assets and time periods. And here's what we get. This histogram shows the distribution of our new refined forecast signal. See that? The crazy signal-breaking outliers are gone. It's not a perfect bell curve or anything, but it's a much more stable, well-behaved signal. This is something we can actually work with. This is the engine for our strategy. So, we've built the engine. Now, it's time for the stress test. We have to backtest this thing and see if our refined signal actually makes money. So how does it perform? Well, the initial results are actually pretty promising. If you look at the Sharpe ratios, which is just a measure of risk-adjusted return, all three versions are profitable. The 120-day version seems to be the sweet spot here. So yeah, our idea works. It makes money. But the real question is, how does it stack up against the absolute titans of systematic trading? This chart puts it all in perspective. This is the horse race. Our skew strategy is the solid black line, and you can see it does well. It climbs steadily over time. But then look at the gray lines. Those are powerhouse strategies like momentum and carry. Our skew strategy is clearly in the race, but, well, it's not winning. And this quote from the source material just says it all, doesn't it? In a straight-up, head-to-head competition, our skew strategy is good, but it's not great. It doesn't beat the top-tier strategies. Now, at this point, you're probably thinking, so why did we go through all this trouble? And that, right there, brings us to the most important insight of this entire process. Because the final blueprint reveals the true power of our skew strategy. Its real value isn't just in its standalone performance. It's in how it behaves relative to all the other strategies. This is the magic number, 0.14. That's the correlation between our skew strategy and the heavyweights, trend and carry. It's incredibly low. It basically means our strategy is marching to the beat of its own drum. Its ups and downs are almost completely independent of the others. And this right here, this is the aha moment. On the left, you see the Sharpe ratio for a portfolio that only trades trend and carry. It's a very respectable 1.27. But look what happens on the right. When we add our good, not great skew strategy into the mix, the entire portfolio's Sharpe ratio jumps up to 1.38. Think about that. We made the whole system significantly better by adding a piece that, on its own, was actually inferior. So here it is, the most important takeaway from all of this. A strategy's true value isn't always measured in isolation. Its most powerful feature might just be its ability to zig when everything else zigs, to provide that crucial diversification that makes the entire portfolio stronger, smoother, and way more resilient. And that kind of leaves us with one final thought to chew on. If a seemingly average strategy like this one can have such a powerful positive effect on a whole portfolio, what other hidden diversifiers might be out there? What other ideas, maybe even ones you've dismissed because they aren't the best, could actually be the key to making your entire approach to the markets that much stronger? It's something to think about. Thanks for tuning in.
Let's be real. Hedge funds have a massive, some might even say unfair advantage in the markets. And it really comes down to one thing, capital. But what if a clever bit of code could actually level that playing field? What if you could get the performance of a multi-million-dollar portfolio, but with just a fraction of the cash? Okay, let's dive into exactly how that's possible.
And just to set the stage, listen to this quote from the source material. It's a pretty bold claim, right? We're not talking about tiny incremental gains here. The author, Robert Carver, is basically saying that if you can move from just a single investment to a super diversified portfolio of about 100 markets, you could see your risk-adjusted returns literally quadruple.
But here's the catch, and it is a huge one. To trade that dream portfolio, that jumbo portfolio, you'd need somewhere in the ballpark of $50 million. Yeah, that's the kind of capital that keeps these incredible strategies pretty much locked away inside major institutions. And that really is the core question we're tackling today, isn't it? If the very best strategies require these astronomical sums of money, is the small trader just permanently locked out? Are you stuck on the sidelines? Or is there another way in?
So first, let's just make sure we're all on the same page about the goal. This jumbo portfolio is pretty much the gold standard. By trading around 100 different futures markets, these huge funds can spread their risk all over the place and catch opportunities no matter where they pop up. It's how they get those amazing, stable, risk-adjusted returns.
Okay, so that's the dream. Now let's get back to reality for, the rest of us. What happens when you try to take that billion-dollar idea and apply it to an account with, say, $100,000? Well, as you can probably guess, the math just completely falls apart. And this slide just lays out the problem perfectly. With that giant $50 million account, maybe the ideal position is 14.2 S&P contracts. No problem. You just round down to 14 and you're in business. But with a $100,000 account, your ideal position is this tiny fraction, 0.0284. And since you can't buy a piece of a contract, that number rounds down to a big, fat zero. You're completely shut out of the trade. So you're stuck, right? You're forced to pick just a handful of markets to trade, and then you're just haunted by that fear of regret. What if you pick the wrong ones? I mean, the source material gives a perfect example. Back in early 2022, the Japanese yen was going wild. It was the only currency future really making a big move. If you didn't happen to pick that one market for your small portfolio, you just missed the whole party.
But here's where it gets really interesting. This is where we pivot from the problem to a really clever solution. What if you didn't have to pick and stick with a few markets? What if, instead, you could dynamically, and I mean every single day, select the perfect combination from all 100 markets to best mimic that ideal portfolio?
The strategy is called dynamic optimization, and it uses something called a greedy algorithm. Now, the name sounds a little aggressive, I know, but the logic behind it is just incredibly smart and, believe it or not, really efficient.
Now, to really get how this works, you have to understand this one key term, tracking error. Think of it like a game of golf. That perfect $50 million portfolio, that's the hole. Your smaller, real-world portfolio, that's your golf ball. The tracking error is just the distance between your ball and the hole. And the goal of the game is simple. Get that distance, that error, as close to zero as possible with every single move you make.
So how does this greedy algorithm do it? Well, it's actually beautiful in its simplicity. Imagine you're packing a suitcase, and you have a perfect target weight you want to hit. You start with an empty suitcase. Then you look at all of your items, and you ask one simple question. Which single item, if I add it right now, gets me the absolute closest to my target weight? You find that one best item, and you put it in. Then you just do it again. Okay, now what's the next single best thing I can add? You just keep doing that, one piece at a time, until adding anything else would actually make things worse. That's the greedy approach in a nutshell.
Let's see it in action. We start at square one with a totally empty portfolio. As you'd expect, our tracking error is pretty high, 2.67%. We are a long way from that ideal portfolio.
Then, the algorithm runs its first loop. It looks at every possible instrument it could add, and it finds that adding just one US 10-year bond future makes the biggest dent in that error. And bam! Look at that. The tracking error gets slashed almost in half, down to 1.53%. That is our first, best, greedy choice.
Okay, round two. The algorithm runs again. It looks at the new situation and asks, what's the next best move? This time, it finds that adding one S&P 500 contract is the answer, and the tracking error drops again, down to 1.506%. See what's happening? It's just building this portfolio piece by perfect piece, always making the most impactful choice it can at every single step.
Now, this basic algorithm is an incredible engine, right? But as it is, it's a bit naive. It's like a lab experiment that doesn't know about the real world. And in the real world, as we all know, trading costs money. So to make this practical, we've got to teach it about transaction costs.
So here's problem number one. Without any constraints, the algorithm would just trade constantly, changing things all the time. It would churn the portfolio, racking up huge commissions and slippage costs that would just eat away at all your returns.
The solution is to make the algorithm cost-aware. Now, don't get intimidated by the math you see on the slide. The idea is actually really simple. We just add a cost penalty right into its decision-making process. So now when the algorithm thinks about a trade, it doesn't just ask, how much does this reduce my tracking error? It also asks, and how much is this trade going to cost me? This simple tweak forces it to ignore tiny adjustments that aren't worth the price. And that brings us to the second challenge. The algorithm can be a little twitchy. Sometimes, the ideal portfolio shifts by a tiny, almost meaningless amount. We definitely don't want our system to make a trade every single time that happens, because the cost of the trade would be way more than any potential benefit.
The fix for this is a brilliant little concept called portfolio buffering. You can think of it as creating a no-trade zone around your current portfolio. The system now has a new rule. If my current portfolio is already close enough to the new perfect one, I'm just going to sit tight and do nothing. This one little rule prevents a ton of tiny, wasteful trades and saves a fortune in costs.
Okay, so we have the theory, we've got the algorithm, and we've added the real-world smarts. Now it's time for the payoff. This is the final showdown. Let's look at the actual back-tested results, putting a $500,000 account using this dynamic strategy head-to-head with that $50 million gold standard. So let's break down this table. What's really fascinating here are the two bottom rows. The Sharpe ratio, which is really just a fancy way of measuring your return for the risk you take, is way higher for our dynamic portfolio. We're talking 1.22 versus 0.94. That's a huge improvement.
But honestly, the number that really blew my mind is that last one, that correlation.
And this chart just drives that point home. It's not even a close fight. With the exact same amount of capital, the dynamic strategy delivered substantially better returns for the amount of risk it was taking. That's not a small tweak. That's a massive leap in efficiency.
And here it is, the knockout punch, 0.99. Do you realize what that means? It means the returns of the $500,000 account were a near-perfect mirror of the $50 million portfolio. It was able to replicate the performance of an account 100 times its size. That is absolutely remarkable.
So this all leaves us with a pretty big question to think about. For decades, access to the best returns in the market was dictated by one thing: access to massive amounts of capital. But strategies like this, they suggest a very different future. A future where intelligent algorithms and smart code might just be more powerful than a massive bank account.
All right, let's jump right in. We're going to leave the slow, steady world of trading behind for a bit and look at something, well, a whole lot faster. You know, most trading strategies are pretty methodical, kind of deliberate. But today, we're cranking that speed dial way up.
Yeah, sedate is a great word for it, isn't it? I mean, think about it. Most of the strategies people talk about, they're looking at daily charts, maybe weekly. They hold on to positions for weeks at a time. And look, they can definitely be profitable, but let's be honest. It's not exactly the heart-racing, high-octane stuff you see in the movies, right?
And that's the big question we're digging into here. What actually happens when we shift our focus, when we stop looking at weeks and start looking at hours or even minutes? Because it turns out, the market's playbook, it totally flips. Right, so here's our first big problem. You can't just take a slow, long-term strategy and hit the fast-forward button. It just doesn't work. Because what you find is that markets have this completely different personality, and it all depends on the time frame you're using to watch them.
You know, there's this common idea that markets are fractal. It's this notion that the patterns you see on a yearly chart just kind of shrink down and repeat themselves on a minute-by-minute chart. But the data says that's just not true. It's a myth. The closer you zoom in, the more the fundamental rules of the game seem to change.
And this right here reveals a really fascinating pattern. The best strategy to use completely flips on its head depending on your timescale. So over many years, you see mean reversion, prices coming back to an average. But then you zoom in to a few months, and suddenly trend following is the way to go. But then you zoom in even closer, down to days or even seconds, and what do you know? Mean reversion is back on top. It's this hidden rhythm, this back and forth, that creates a really interesting opportunity.
So that pattern, that's our way in. That's our strategy. We're not going to try to follow the trend. Nope. We're going to do the opposite. We're going to bet against it, specifically looking for that snapback to the average, but on a super fast timescale.
And the core idea is actually really simple, super intuitive. Just think of a rubber band. When a price gets stretched way too far from its recent average, well, that's the rubber band being pulled tight. And we're just betting that it's going to do what rubber bands do, snap back to the middle.
Okay, so how do we actually define that middle of the rubber band? Well, we start by calculating something the source material calls the equilibrium. Now, don't get bogged down in the math here. Just think of it as a really smooth, stable average price that we're calculating based on the last 5 days of data.
All right, once we have that smooth average, we can generate our trading signal. This is called the raw forecast, and it's literally just the difference between our smooth equilibrium line and the current live price. So if the price right now is below that average, boom, that's a positive signal. Time to buy. And if the price is above the average, you guessed it, a negative signal. Time to sell. It's really that straightforward.
And here, you can really see it in action. That smooth black line, that's our equilibrium. The choppy gray line, that's the actual price moving hour by hour. And you can see what the strategy is doing. It's constantly selling when the price jumps above the average and buying when it dips below. Just always betting on that snapback.
Now, all of this sounds pretty good in theory, right? But in the real world, trading this fast brings a huge new problem to the table. And honestly, it's a problem big enough to kill the entire strategy. See, because we're reacting to every little hourly wiggle and jiggle around that average price, the system is just constantly firing off trades. Buying, selling, buying, selling. The sheer number of trades just goes through the roof compared to a normal, slower strategy. So just how fast are we talking? Well, get this. The strategy turns over its entire portfolio 140 times in a single year. To put that in perspective, that means the average time you're holding any position is less than 2 days.
That is incredibly fast. And that leads us to the million-dollar question, or maybe the eaten by 1,000 cuts question. Every single one of those trades costs money. With that much churning, are we just generating a ton of commission for our broker while all those little fees completely gobble up any profit we might have made?
Okay, let's see how we can tackle this cost problem, because there's a really clever trick in how you execute the trades that changes everything. And this is where it gets really cool.
The secret weapon here is to stop using market orders and start using limit orders. See, with a market order, you're what's called a price taker. You just hit the button and you get whatever the current price is. And for that convenience, you pay a small fee called the bid-ask spread. But with a limit order, you flip the script. You become a price maker. You say, this is the price I'm willing to pay, and you wait for the market to come to you. And by doing that, you can actually avoid paying that spread.
So check this out. Instead of chasing the price around and paying the fee every time, this method is all about setting traps. You figure out the exact price that would make you want to buy one more contract or sell one, and you just place your orders there, waiting. You're letting the natural bounce of the market do all the work, triggering your trades for you, and saving you an absolute fortune in transaction costs along the way.
Okay, so with this awesome cost-saving trick, the strategy is back on the table. It actually works. But, and this is a big but, it comes with a pretty serious health warning. First, let's talk about the good news, because the performance is really impressive. This table here shows the Sharpe ratio, which is basically a way to measure your return for the amount of risk you took on. Higher is better. And at 0.80, this fast mean reversion strategy is performing right up there with some of the best trend-following systems out there. So yeah, it definitely has an edge.
But here's the flip side, the dark side of that performance. Just look at that black line on the chart. This is a textbook example of something called negative skew. What does that mean? It means you make nice, steady, consistent money for a long, long time. And then, out of nowhere, like during the COVID panic in 2020, you get hit with a sudden, absolutely catastrophic loss.
And why does this happen? It's baked into the strategy's DNA. It is designed to fight the trend, to bet against momentum. And most of the time, that works great. But when a huge, powerful, persistent market move happens, the strategy just keeps fighting it. It keeps buying as the market is crashing or selling as it's rocketing up. It's what traders call catching a falling knife. And you do that until your losses are just devastating.
And this really is the key takeaway, right from the author himself. It's that tendency to just hang on to losing positions, to keep fighting a strong trend. That's what makes this strategy very dangerous indeed. It has a real edge, for sure, but it's a double-edged sword that you have to treat with a ton of respect.
So that leaves us with one last, really interesting question. We've got this tool that's clearly powerful, but also clearly dangerous. Is there a way to harness its power to get those profits while somehow protecting ourselves from those brutal account-blowing crashes? Well, the author hints that there just might be a way, but that, my friends, is a story for another time.
So what if you could take a trading strategy that's known for being incredibly risky and, well, make it safe? Today we're diving into a really clever piece of financial engineering that tries to do exactly that, pulled from Robert Carver's Advanced Futures Trading Strategies.
It's kind of the holy grail in finance, right? We're going to break down how you can take a powerful but, let's be honest, dangerous trading concept called mean reversion and bolt on some ingenious safety features to make it way more robust.
Okay, so what exactly is mean reversion? The idea at its heart is pretty simple. Prices tend to snap back to their long-term average. It's basically a bet that what goes way up must come down, and what goes way down must come back up. But, and this is a huge but, there is a massive, glaring problem with this. If a price just keeps falling, a pure mean reversion strategy will just keep buying more and more and more, thinking it's getting a bargain. As the author perfectly puts it, this is like catching a falling knife, and it can lead to some absolutely catastrophic losses. So, how do we stop our strategy from catching that falling knife? Well, the very first safety feature we're going to add to the system is something called a trend filter.
The logic here is just so intuitive. Instead of fighting every single price move, you modify the strategy to only place trades that go with the flow of the bigger long-term trend. Think of it like surfing a wave instead of trying to swim against the current. And this slide really shows you how that works in practice. So if the market's in a clear uptrend, like you see on the left, you'll still buy those temporary drops. You'll buy the dips. But, and this is the crucial part, you will not short the rallies.
You just don't bet against a strong, rising market. And of course, in a downtrend, you just do the exact opposite.
And this is what's so elegant about this solution. It's actually way better than a simple stop loss because it's not based on some random price level you have to guess at. Instead, if the market turns hard against your position, the long-term trend itself will eventually flip, and that forces the strategy to close the trade automatically. It stops those runaway losses in their tracks.
All right, now for the second ingredient in our recipe for a safer strategy. We need a shield, something to protect us against those sudden market storms.
See, mean reversion loves calm, stable, boring markets. That's where it thrives, but it gets absolutely crushed by sudden spikes in volatility. You know, the kind of chaos we saw during major global events. When markets get crazy, this strategy can get wiped out.
So the solution is this dynamic defense system. The strategy is constantly taking the market's temperature, measuring how choppy it is, comparing that to the last decade. And if things are getting too wild, it automatically shrinks the size of its bets. It's all about protecting your capital when risk is highest.
Let's dig into the mechanics just a little bit. This first formula, V, it's asking a really simple question. Is the market acting crazier today than it has, on average, over the last 10 years? That long-term window is so important because it gives us a really stable baseline for what normal actually looks like.
Okay, so the next step, Q, takes that information and ranks it. Think of it like a percentile score for chaos. Is today one of the calmest 10% of days we've seen in the last decade, or is it in the most chaotic 10%? This tells the system not just if volatility is high, but how high it is compared to history.
And this final step, M, is where the magic happens. The system creates this multiplier. So when volatility is normal, M is high, and your trades are full size. But as volatility spikes and that Q value gets closer to 1, the multiplier just shrinks, automatically scaling back how big your position is. It's like an automatic dimmer switch for risk.
So, we've added a trend filter to stop fighting the market, and we've added a volatility shield to protect against chaos. So, did it work? Let's take a look at how this completely transforms the strategy's performance.
This really is the moment of truth. After all that clever engineering, what's the actual payoff? Well, let's look at the numbers from the backtest, which covers just under a decade of trading across a whole bunch of different assets.
The results are, well, they're pretty dramatic. Just look at the skew. It flips from viciously negative, which means the strategy is prone to these rare but massive account-destroying losses, to positive. That's a much healthier profile of small losses and the occasional large win. And then there's the Sharpe ratio, a key measure of risk-adjusted return. It more than doubles.
And to put that number into perspective for you, a back-tested Sharpe ratio over 2 is exceptionally rare. It's seriously considered the holy grail by many quantitative traders. It means you're getting an incredible return for the amount of risk you're taking on.
And this chart just brilliantly illustrates the difference in the real world. That gray line, that's the original dangerous strategy. The black line is our new safer version. And just look at what happens. See how it protects capital and just pulls away during the crazy volatility of the pandemic in 2020 and the invasion of Ukraine in 2022? It turns those moments of pain into periods of strength.
But okay, before we get too excited and think we've stumbled upon some kind of magic formula, the author himself gives us some really crucial, hard-earned words of caution.
I mean, that is a massive reality check coming from the guy who created the strategy. When a result looks this good, even too good to be true, it often is. So what are the potential catches with these incredible-looking results?
The source material lays it out very clearly. First off, this is not investment advice. But beyond that, this is not a simple system for you and me. It requires an immense amount of capital. The author literally mentions $50 million, plus deep, deep technical expertise and a fully automated system to even run it. And even then, the backtest period is pretty short, and as we all know, past performance is never a guarantee of future results.
And this really leaves us with a final fascinating thought. We've seen exactly how you can engineer safety into a strategy that is inherently risky, basically turning a falling knife into a precision tool. But in doing so, it just highlights the immense complexity, the capital, and the skill that's required to play at the highest levels of finance. The strategy is safer, yes, but getting there is anything but simple.
Okay, let's dive right in. We're going to talk about a pretty advanced trading strategy, one that promises to shield you from those wild, unpredictable market swings. But, and this is a big but, it hides a really dangerous secret of its own.
So first things first, before we get to the solution, you really have to understand the problem. let's set the stage and look at the fundamental risk that just comes with standard everyday trading.
You know, this quote just hits the nail on the head, doesn't it? It perfectly captures that deep down fear every single trader has. You can do all the homework, you can be 100% right in your analysis, and still get totally wiped out by some giant unforeseen event that was completely out of your control.
And this really gets to the heart of it. Doesn't matter if it's a central bank decision, a weird weather pattern, or some global meltdown. When you're just betting on the direction of one single thing, you are totally at the mercy of, well, everything. You're completely exposed.
So what's the alternative then? I mean, how do you build some kind of defense against all that chaos? Well, the strategy is called relative value, but you'll probably hear it called spread trading more often.
The difference here is actually pretty simple, but it's also profound. Instead of asking, hey, is the S&P 500 going to go up? You're asking a totally different question. You're asking, will the S&P 500 go up more than the Euro stocks? See the difference? In theory, if the whole market just falls off a cliff, you're hedged, because both your long and your short positions go down together. You've isolated your bet.
Now, this is a really crucial point. You're not just trading two different things at the same time. You are actually, mathematically, creating a brand new synthetic instrument. And this new thing, it has its own unique price, its own volatility, its own risk profile. It's a whole new ballgame.
So how do you actually cook one of these things up? Let's get into the recipe. To make this all feel a bit more real, we're going to stick with just one single example for the rest of this explainer. We are going to pit the 5-year US bond against the 10-year US bond. Now, these two are obviously related, but, and this is key, they don't move in perfect lockstep.
Okay, here's the core of how it works. Don't let the formula intimidate you. It's pretty straightforward. The price of our new spread instrument, that's P delta there, is calculated by taking the price of the bond we're long, multiplying it by a special ratio we'll call R, and then just subtracting the price of the bond we're short. Simple as that.
Now let's plug in some actual numbers and see it in action. If we use a ratio of 1.5 and we have our bond prices, boom, suddenly we have a single tradable price, 49. And that number, 49, that's the price of our synthetic instrument. It's not the price of either of the individual bonds.
Right, and that is the most important question in this entire strategy. That ratio, that R, is literally everything. If you get it wrong, you don't just ruin the hedge, you could actually be adding more risk. So, how do we find the perfect number?
Well, the goal at this stage isn't actually about maximizing profit. It's about maximizing stability. You find the best ratio by figuring out which one creates the least volatile, most stable spread price possible. And the math for that? It's surprisingly simple. You just divide the standard deviation, which is just a measure of risk, of one instrument by the other.
And would you look at that? When we plug in the actual risk numbers for our two bonds, the math spits out 1.499. So our example ratio of 1.5 wasn't some random number we pulled out of a hat. It was the mathematically optimal ratio to minimize the risk in this very specific trade.
Okay, so here's where things get really interesting. Because in the process of squashing all that risk and volatility, you accidentally create a brand new kind of challenge.
And I mean, the strategy clearly works. Just look at the chart. The volatility of our spread, down at 0.159, is way lower than either of the individual bonds. This is proof positive that the hedge is doing its job. It's smoothing everything out.
But here's the paradox. Because you've so brilliantly engineered the volatility out of the price, the day-to-day price movements of your new instrument are tiny. They're just little wiggles. So to make any kind of real money from those little wiggles, you have to scale up your position. A lot.
So let's imagine you set aside $500,000 of your capital to run this strategy. That's your stake.
Well, to trade that spread effectively, your actual exposure in the market, the notional value of your combined long and short positions, is over $5.5 million. That's more than 11 times your capital. We're talking about a huge amount of leverage here.
And that massive leverage, that is precisely what exposes the strategy's hidden weakness. It's something we're going to call the correlation trap. You see, this whole thing, the hedge, the low volatility, all of it, is built on one single assumption, that the historical relationship between these two bonds is going to continue. In our example, they have a correlation of 0.961. That's almost perfect lockstep. The strategy is betting the farm that this relationship holds true.
So the terrifying question is, what happens if that stable, predictable relationship, The one you've leveraged up more than 11 times suddenly breaks.
This is the trap. A change that seems pretty small, a drop in correlation from 0.96 to 0.86, causes a massive, non-linear explosion in your risk. Your so-called low-risk position suddenly becomes incredibly high risk almost overnight. That can trigger margin calls and maybe even a death spiral where you're forced to sell into an already bad market, making things even worse.
And that's the ultimate warning right there. This isn't some theoretical what-if scenario. This exact failure mode, a hedge that just suddenly stops hedging, has been at the scene of the crime for some of the most catastrophic losses in financial history.
So what's the final takeaway? Spread trading is an incredibly powerful tool, no doubt. It lets you isolate a specific bet and filter out all that market noise. But its safety is really just an illusion if you don't account for its one critical point of failure. You have to realize that understanding and managing that correlation risk, well, that isn't just part of the strategy, it is the strategy.
All right, let's get into it. So you've probably heard of trading a single stock. Maybe you've even heard of pairs trading, betting on two assets against each other. But what's the next level up? Well, today we're jumping into the deep end with trading triplets, where you're juggling not two, but three instruments at once.
So let me just start with a simple question to get our heads in the right space. What could possibly be more complicated than trying to manage a position in one asset while you're shorting another at the exact same time?
Yup, trading three. And it might sound like, oh, it's just one more, but believe me, adding that third leg to the stool completely changes the game. It ramps up the sophistication, and as we're going to see, it really ramps up the risk. And look, let's not beat around the bush. The source material for this whole explainer from a trader named Robert Carver is incredibly blunt. He calls this strategy dangerous and toxic. He warns what all the tricky parts of spread trading, things like high leverage and costs, they get even worse with triplets. So right off the bat, know that this is pro-level stuff. Okay, so with that pretty serious warning ringing in our ears, let's actually break this thing down. Let's get into the anatomy of it. What exactly is a triplet?
So a standard spread, that's pretty simple, right? You go long one thing, you short another. A triplet adds another layer. You short that middle instrument, but you go long on the two on either side of it.
And this structure has a pretty famous name, a butterfly spread. Now, this analogy is really the key to understanding it. The instrument you're shorting, that's the body of the butterfly. And the two you're buying are the wings. The goal here isn't to bet on the whole market going up or down. Nope. It's a very precise bet on how the relationship between the body and its wings is going to change over time. Okay, so how do traders actually put one of these together? We're going to glance at the math, but don't worry, we're not going to get lost in the weeds here. It's the logic behind the numbers that's really important. So at its core, the price of a triplet isn't something you can just look up. It's a synthetic price that you have to calculate. You take the price of your two wings, you multiply them by some very specific weights, and then you subtract the price of the body. You're basically creating a brand new artificial instrument out of three real ones. Let's make that a little more concrete. In this example from the source, our wings are 2-year and 10-year US bonds, and the body is the 5-year bond. You can just plug in their real prices, apply the weights, and bam, you get a single synthetic price for your butterfly. So the million-dollar question is, where do those weights come from? They're not random. Traders do some serious analysis. They look at the volatility of each bond, and crucially, they measure the correlation, how they all move together. The whole point is to find the perfect weights that make the triplets price as stable and non-volatile as possible, basically hedging out all the extra market noise. And here's what that looks like in the real world. You can see how that formula takes the actual data for those bonds and spits out the exact weights you need to perfectly balance the butterfly's wings against its body. Now, creating a super stable hedged instrument. That sounds awesome, right? Almost foolproof. Well, this is where the danger comes creeping in. That stability has a massive, and I mean massive, financial consequence. Just take a look at this number, $10.4 million. That is a staggering amount of money. Where on earth does a number that big come from in what's supposed to be a hedged trade?
Well, this table from the source tells the whole story. It shows the total notional exposure. That's the total value of the assets you're controlling for different trades that are all targeting the same amount of risk. If you just trade a single 5-year bond, you're controlling under $1 million worth of assets. Okay, a simple spread, that jumps to 6.7 million. And our triplet, it just blows them away, skyrocketing to over $10 million.
So why? Why is the number so gigantic? It's actually a paradox. Because that synthetic triplet is designed to be less volatile and less risky, its price doesn't really move that much. So to make any decent money from those tiny little wiggles, traders have to use an absolutely enormous amount of leverage. And of course, massive leverage means you need a massive pile of your own cash just to get a seat at the table. For our US bond triplet example, the source calculates that you'd need a minimum of over $200,000 of capital, and that's just for the smallest possible trade size. But this isn't just some weird theoretical exercise for bond geeks. This butterfly structure, it pops up all over the place, in all kinds of different markets.
In the bond market, we've seen it's a bet on the curvature of the yield curve, which is basically a bet on the future of the economy. In stocks, you could bet on mid-cap companies outperforming both the giants and the small fries. And in commodities, you get these really famous trades like the soy crush spread, which is essentially a bet on the profitability of a soybean processing plant, or the oil crack spread, which does the same thing for refining crude oil. These are direct bets on industrial economics.
Now have a look at the price chart for that US bond triplet. See how it mostly just bounces around inside a pretty contained range? That's that careful hedging at work. You've isolated a very specific and relatively stable economic signal.
But now, look at this. This is the soy crush triplet. It is a completely different animal, isn't it? It's way more volatile, much more directional. And this contrast just goes to show you that even though the structure is the same, the behavior of the triplet depends entirely on the real-world economics of its parts. Agricultural processing is just a lot messier and less predictable than interest rate policy. So after looking at the structure, the crazy risks, the real-world examples, what's the big picture? What's the main thing to walk away with here? Well, the most crucial point is that triplets are not about betting if the market's going to go up or down. Not at all. They are a highly specialized tool. They allow traders to isolate a very specific economic idea, the curvature of a yield curve, the profitability of a refinery, and place a pure bet on the relationship between those three parts. It's all about relative value. And that brings us full circle, right back to where we started. This is a complex instrument, and with great complexity comes great risk. The insane leverage, the high costs, the huge capital you need, it all means this is a strategy firmly in the domain of sophisticated, well-capitalized institutional traders. But it does leave you with a fascinating question to chew on. Once you realize it's possible to isolate and actually trade the relationship between three interconnected things, well, it makes you wonder, what other complex patterns out there, things that most of us just dismiss as random noise, could actually be a clear tradable signal waiting to be discovered?
All right, let's talk about a really powerful but kind of misunderstood financial strategy called calendar trading. It's a whole different way of thinking that shifts the focus from an asset's price to time itself.
You know, most of the time when you make a trade, you're betting on whether a price will go up or down. Simple enough. But what if you could bet on the relationship between that asset's price in, say, June versus its price in December? Well, that's a completely different ballgame. And that's where things start to get really interesting.
Okay, so to really wrap our heads around this, let's start with the problem calendar trading was built to solve. You see, for ages, traders have tried to play the relationships between different assets, but honestly, it's way harder than it looks.
And here's the core of it. Trying to trade the relationship between two different things, like US bonds and German bonds, it's a real headache. The relationship can be unstable, the math gets messy, and you're juggling a bunch of moving parts. But what if you trade different future versions of the same asset, like June oil versus December oil? Now that is a much cleaner, more direct bet.
This simple yet powerful idea leads us directly to this really clever tool for trading an asset against itself across time. The calendar spread. Think of it as one single synthetic trade that's designed specifically to capture this kind of time-based relationship.
So what is it exactly?
Well, it's a single trade where you take a position on one future date, let's say you sell a December contract, and at the exact same time, you take the opposite position on another date, like buying a June contract. You're not trading two separate things anymore, you're just trading the difference between them.
And the structure is actually super straightforward. You're buying one future and selling another simultaneously. For example, you could buy a June contract and sell a December contract. This creates a single combined position, and it makes money if the price for June goes up relative to the price for December.
And, you can even take this one level deeper. A calendar triplet brings a third point in time into the mix. So, for instance, you might sell the contract for a middle date while buying contracts for both an earlier and a later one.
So why bother with all this complexity? Well, this quote just nails it. With a simple two-part spread, you're basically betting on the slope of the price curve over time. Is it getting steeper or is it getting flatter? But with a triplet, you're betting on its curvature. Is it bending upwards or downwards? You're moving way beyond just betting on price. You're betting on the actual shape of the future.
Now, here's where things get really elegant. This whole strategy neatly sidesteps a massive mathematical headache that trips up a ton of other complex trades.
You see, when you trade two different assets, you have to figure out a really precise hedge ratio. This R right here. It's this formula that tells you exactly how many units of one thing you need to offset one unit of the other, and it's all based on how much each one tends to bounce around. It's complicated. But with calendar spreads, everything changes. Because you're trading the same underlying asset at different times, a really useful market convention has popped up. Traders just assume the volatility is the same for both dates. And with that one simple assumption, that complicated hedge ratio R, it just becomes 1. And just watch what happens to the math. That whole complex ratio collapses into a beautiful, simple subtraction. The price of your spread is just the price of one contract minus the price of the other. All that messy algebra, it just vanishes, and the whole strategy becomes so much more intuitive.
But of course, you knew there had to be a catch, right? There's no such thing as a free lunch in finance. And this simplicity comes with a really significant and sometimes pretty dangerous trade-off.
So here it is. For the same amount of risk you're willing to take, moving from a simple directional trade to a calendar spread can multiply your effective leverage by around 5 times. All of a sudden, you're controlling a much bigger position than you might think.
And you can see that jump in size right here. These are some numbers for the VIX Volatility Index. To get the same level of risk, a simple trade might control about $100,000. But with a spread, that jumps to over $500,000. And with a triplet, you're suddenly on the hook for over $2 million. The scale just explodes.
Now, this hidden leverage creates a really unique kind of performance. Look at this chart of a crude oil spread. For years, it's pretty calm, just trading in a tight little range. But then, a crisis hits, like the one in 2020, and bam, the price makes this massive, violent move. That's the leverage kicking in. This gives these strategies a really distinct personality. They're often quiet, maybe even losing a tiny bit of money during calm markets. But then they roar to life during market shocks, and they're capable of generating huge returns or, of course, huge losses during those really unpredictable tail events.
So, okay, let's pull all this together. What's the big picture here? What's the key takeaway?
When it comes down to it, calendar trading is a real double-edged sword. On one hand, the advantage is that it simplifies your bet. You get to isolate the time variable, and the math gets way easier. But on the other hand, the risk is that by doing so, you dramatically magnify your leverage, which makes you incredibly sensitive to market crises.
And because of that high leverage nature, you can't just trade these strategies anywhere. You need markets with a ton of activity across many different future dates. We're talking about huge, global markets like volatility, interest rates, energy, and major agricultural commodities.
Which really leaves us with a final, kind of provocative thought. Calendar spreads are an attempt to simplify a very complex problem, predicting the future. But in the process of simplifying, they amplify the consequences of being wrong. So it forces us to ask a really fundamental question. In the world of trading, what's the real price you pay for simplicity?
Today, we are diving deep into a really critical and honestly often overlooked part of the financial world, futures trading. And we're going to focus on one single concept that really separates the pros from the amateurs, and that's the art of the roll. It all kicks off with one pretty provocative idea.
So let's start with this quote from our source material. There is no such thing as a VIX US volatility future. Now, that just sounds kind of pedantic, right? I mean, of course VIX futures exist. People trade millions of dollars worth of them every single day. But this little technical point is actually the key to unlocking everything that follows.
You see, what the author is really getting at is that there's no perpetual future. You can't just buy a contract and, hold it for 10 years. They all have expiration dates. And this creates the central puzzle for any long-term futures trader, and it's the one we're going to solve today. If you can't hold on to a future forever, how on earth do you maintain a position over time?
This right here is what the source material calls the perpetual future problem. Every single futures contract has a ticking clock attached to it. It's not a buy and hold asset like a stock. It's more of a buy and decide asset. You are constantly being forced to make a decision before that clock hits zero.
A really great way to think about this is like a car lease. You get to use the car for a set period, but you know from the moment you sign the papers that the lease will end. And before it does, you have to figure out, okay, which car am I getting next and how am I going to make that switch without being stuck without a ride? It's the exact same logic in futures. You're basically leasing a position in the market.
So, here's our roadmap for today. We've laid out the problem. Now we're going to break down the 3 key decisions a trader has to make: which contract to choose, when to make the switch, and how to actually do it. And then we'll wrap it all up by seeing why these little operational details matter so much.
First up, choosing your next contract. And let me tell you, this isn't just about picking the next month on the calendar. Nope, it's a real strategic choice. And the very first step is running the potential contracts through a series of filters.
So, there are 3 main hurdles any potential contract has to clear. First, and honestly most important, is liquidity. Then, a trader's got to assess the risk profile of that specific contract. And finally, they have to understand the delivery type, because getting that wrong can have some, well, let's just say, surprising consequences.
Let's start with the absolute deal breaker, liquidity. All this means is, can you get in and out of a position quickly without the market moving against you just because you're trading? If a contract isn't liquid, if there aren't enough buyers and sellers, it's just too dangerous and too expensive to even think about. It's the first and most important filter, hands down.
And traders don't just guess about liquidity, they quantify it. They use a formula like this one to calculate the daily trading volume in terms of actual dollar risk. They're looking for contracts that clear 2 key thresholds, an average of at least 100 contracts traded per day and a minimum of $1.25 million in daily risk volume.
And here's what that filtering process looks like in practice. This table shows VIX futures data from May of 2022. You can see the contracts from June all the way to December pass the test with flying colors. But look what happens when we get to January and February of 2023. The volume just falls off a cliff. They don't meet the minimums, so they're immediately filtered out. Untradeable. Simple as that. All right, so once a contract passes that liquidity test, the next big question is about how it settles. Is it cash settled, where money just changes hands when it expires? Or does it involve physical delivery, where you could end up with, the actual thing, the corn, the oil, the wheat?
And the danger of physical delivery is not some abstract theory. Our source shares this incredible story about the famous economist John Maynard Keynes. He was managing an endowment, and he kind of messed up a futures position and literally had to accept a delivery of wheat. He was forced to store it in the crypt of a Cambridge chapel. It just goes to show even one of the greatest economic minds ever can make a huge mistake if they ignore these little operational details.
Okay, so you filtered your options, you've picked a target contract. Now for the second big decision, the art of timing. Exactly when should you make the switch?
Well, the process isn't random. Traders act on very specific triggers. Typically, you'll roll a few days before your current contract is set to expire. For physical contracts, you absolutely, positively must get out before the first notice date to avoid that Keynesian wheat problem. And of course, you can only roll into a new contract once it's become liquid enough to trade safely.
But you might be thinking, does it really matter if I roll on a Monday versus a Wednesday? It seems kind of trivial. Well, it might seem that way, but our source highlights this fascinating case where researchers discovered a subtle but pretty costly anomaly tied directly to roll timing.
So this research team was cleaning up historical price data. They adjusted the roll dates in their model to be more realistic, just a few days earlier than what they'd assumed before. They were shocked by what they found. The old price charts and the new ones, they didn't match. This more realistic timing actually resulted in slightly lower historical returns, which proves that even a few days' difference can have a real, measurable financial impact. Crazy, right?
So you've chosen your contract and you know when you want to roll. Now, how do you actually do it? How do you execute the trade? Well, even in the mechanics of the switch, there are strategic choices you have to make.
There are basically two main ways to get this done. You could do two separate trades, sell the old contract, wait for it to fill, then buy the new one. But that's risky. I mean, what if only one of those trades executes? A much better way is to use something called a spread trade. This is a single order that executes both parts of the trade at the same time, making it cheaper and totally eliminating the risk of being left with a mismatched position.
Now, for very active traders, there's an even more advanced technique, passive rolling. This is the cheapest method of all because it doesn't involve any extra trades. You just change your behavior. Anytime you need to sell, you sell from your old contract. Anytime you need to buy, you buy the new contract. And over time, your position just sort of migrates automatically. It's really quite slick.
Now, there is one last mechanical detail we need to think about, and it's known as the sawtooth effect. Here's the deal. Different contract months can have different levels of volatility. This means when you roll, you might be unintentionally changing the overall risk of your position, which means you might need to adjust your size. Here's a really concrete example of what I'm talking about. Imagine you're rolling from a contract that has 51% volatility to one that has 44% volatility. To keep the same exact level of risk, a 100 contract position now needs to become a 116 contract position. You actually have to increase your position size just to keep your risk constant. It's kind of weird, and it creates this sawtooth pattern in your position size over time.
So we've walked through the what, the when, and the how of rolling. Let's wrap this all up by really reinforcing why mastering these seemingly tiny operational details is so fundamental to successful trading.
So what are the key rules of thumb to take away from all this? First, only ever trade liquid contracts. I can't stress that enough. Second, try to avoid the very front month contract if you can. Its price can be kind of jumpy and less predictable. Third, contracts that are further out in time often have better risk properties and reduce how often you even need to roll. And finally, think about using fixed calendar months to avoid any weird seasonal effects. And remember, it's perfectly fine to hold positions in multiple expiries at once.
And that brings us to our final question. We've just spent this entire explainer unpacking the immense detail and strategy that's required simply to maintain one position. So it's really worth asking, if this much thought goes into a single roll, what other hidden complexities and unseen forces are shaping the financial markets we interact with every single day?
Okay, picture this. You're sitting in a university lecture hall. A guest speaker, some legendary trader, walks on stage, puts up a totally blank slide and says, "Folks, I'm going to let you in on a secret. There are only 2 ways to make money in trading." That's it. 2 things that are the secret to all my success. The room goes silent, everyone's leaning in, and then he reveals the big secret. And this is it. You can just feel the air go out of the room. I mean, it's so simple. But that simple, almost boring statement is the key to everything. Because while it might seem obvious, one half of that equation is something that most traders completely, utterly ignore. So what are the 2 ways? Well, number 1, make more money from your actual strategy. And number 2, pay less in trading costs. Now, almost the entire trading world is obsessed, and I mean obsessed, with the first part, finding that one perfect magic strategy. But the author we're looking at today argues that a massive and often totally hidden edge comes from mastering the second part, actively managing and protecting your capital by cutting the cost of every single trade you make. So where in the world do we start with managing these costs? Well, it all kicks off with a principle you've probably heard a million times in business or even sports. This is our North Star. You can't just guess that your costs are high. You can't just have a feeling you're paying too much. To actually get better at execution, you need cold, hard data. You have to measure with precision exactly what you're paying on every single trade. So how do you actually do that? Well, the author uses this really smart 3-pronged approach. First, he gets a baseline, kind of like a feel for the room, by sampling spreads all day long. Then he zooms right in, recording the spread at the exact moment he's about to place an order. And finally, and this is the most important part, he measures his actual fill price against the market's mid price. This whole process gives him a complete picture, from the big general market environment right down to the nitty-gritty cost of one specific trade. You know, once you start measuring this stuff, you notice something pretty quickly. Your trading costs aren't constant, not even close. They jump all over the place. And that insight right there leads to the simplest and honestly the most powerful way to cut your costs. Knowing when to trade, and maybe even more importantly, when to just sit on your hands. Think of these times as the market's rush hour traffic jam. During the open, the close, or right around a big news announcement, those bid-ask spreads, the gap between the buying and selling price, they just blow out. They get super wide. Liquidity dries up, and that means it is simply more expensive to get anything done. Trading during these periods is like willingly paying surge pricing on an Uber. Smart traders, they wait for the traffic to clear. And this right here shows you exactly what I'm talking about. What you're seeing are the bid-ask spreads for Euro-dollar futures broken down by the hour of the day. Just look at those massive bars on the left. That's the overnight session. The cost to trade is dramatically, unbelievably higher when the main market is closed. If you trade then, you're just paying a massive premium for absolutely no good reason. Okay, so avoiding the market's expensive rush hours is a great first step. It's a huge win. But what about when you do have to trade? This is where we level up our game. We're moving beyond just hitting buy or sell and into the world of smart execution algorithms. Now, to understand algos, you first got to get this fundamental choice every single trader makes. With a market order, you get certainty. Bam, your trade is done. But you always pay the toll, the bid-ask spread. With a limit order, you can get a much better price, but you run the risk of the market running away from you and your order just sitting there, never getting filled. It is the classic trade-off, certainty versus cost. But what if you didn't have to choose? What if you could get the best of both worlds? Well, that's exactly where an execution algorithm, or algo, comes in. It's basically a smart tool that decides for you. It knows when to be patient and wait for a better price, and when to get aggressive to make sure the trade gets done. So here's the basic logic of the simple algo the author built himself. First, it starts out passive. It's patient. It places a limit order to try and get a better price. But, and this is key, it's constantly watching. It's looking for triggers, like if the price starts moving against it, or, hey, if it's just been waiting too long. If any of those triggers get hit, it instantly flips the switch, goes aggressive, and makes sure the trade gets done. It's basically patience with an escape hatch. And the results, they are just fascinating to look at. This is from the author's own trading account. That light gray line sloping down shows what his costs would have been if you just used standard market orders, a 3.6% drag on his capital. Ouch. The dark gray line is what he actually paid, which was closer to 3%. And the difference between them, that's the black line at the top. That's the pure profit his little algo generated just by being smarter about how it placed his trades. Let me put that another way. This simple piece of code reduced his total trading costs by 1/6. Just stop and think about that for a second. That's not from finding a better strategy for what to trade. It's purely from optimizing how he traded. That is a real, significant, measurable edge. All right, so let's bring all this home. We'll look at one more advanced tactic, and then we'll sum up the key lessons from all of this. You can actually take this whole principle even further with techniques like an order ladder. Instead of just placing one limit order and hoping for the best, you can preload the market with a whole series of orders at different prices. This lets you kind of scale in and out of your positions much more smoothly, especially in a fast market, without having to react in a panic every time. So let's recap the big ideas here. First, and this is crucial, remember that trading costs are not fixed. They are a variable that you can and should control. To do that, you have to measure them, obsessively. The easiest one you can get is to just stop trading when the market is thin and expensive. And for a more lasting edge, a smart execution algo can systematically save you money. It all comes down to this one final critical idea. How you trade is every bit as important as what you trade. And that really leaves us with one final question to think about. In a world where everyone is constantly chasing the next hot tip, the next secret signal, maybe the real secret has been hiding in plain sight this whole time. Not in the glamorous work of picking winners, but in the quiet discipline of excellent execution. So, where is your focus? Okay, so when you think about futures trading, what comes to mind? Probably the cool stuff, right? The killer strategies, the big market moves, all that excitement. But what if I told you the single most important part of your account is, well, the part we never ever talk about?
We're going to crack open Robert Carver's advanced futures trading strategies to look at cash and compounding. And trust me, this isn't the boring accounting stuff. This is the secret engine that makes the whole thing run or not run. Yep, you heard me. It's your cash. Just think about it. Your trading account is like this high-performance race car. The futures contracts, that's the slick paint job, the spoiler, the stuff you're actively steering. But your cash? Oh, that's the engine room. It's not glamorous, but it's where all the power comes from. It's what decides if you even get to finish the race or if you stall out on the very first lap. And let me tell you, if you mess this part up, I don't care how great your strategy is. It won't save you.
All right, so where's the first place this all goes wrong for so many traders? It's margin. It's this surprisingly easy trap to fall into, and it always ends with those two words that nobody ever wants to hear: margin call.
So let's just walk through how this nightmare scenario plays out, and you'll see how fast it happens. Okay, step 1. You start with a nice, healthy account, $500,000, all free cash. Sweet. Step 2, you dip your toe in, buy one little S&P micro contract. A tiny bit of your cash moves to cover the initial margin. No big deal. But then step 3, a small loss. Now, pay attention here. That $200 gets pulled directly from your free cash. This is key. And then comes the big mistake. Step 4. You decide to go all in. You use up almost all your remaining cash to load up on contracts. And that's the tipping point, because now, look at step 5. Just a tiny $5 loss per contract, which is nothing, right? But it adds up to over $2,000, and you've only got $700 left in free cash. So what happens? Step 6. Boom, margin call. Now your broker's on the phone, and they're the ones calling the shots.
So, how in the world do you avoid that mess? Well, the author gives us a super simple but really powerful rule of thumb from his own playbook. Aim to keep about 70% of your account value as free cash. Now, I know what you might be thinking. That's just dead money sitting there. But it's not. It's your safety buffer. It's your fuel reserve. It's the cushion that lets you absorb those little losses without ever getting that dreaded call. Okay, that leads us right into the next big question, what Carver calls the Goldilocks problem. It's all about this. How much of your total trading capital should you actually keep sitting in your brokerage account? Is there a just right amount? So you've got two extremes here. On the too cold side, you can undercapitalize. You keep most of your trading funds in a separate bank account, maybe earning a little interest. Sounds smart, right? But what happens when you take a big hit and you need to wire money in fast? It's a huge pain. And even worse, Carver warns it can create this really bad habit of just constantly throwing good money after bad. Then you have the too hot side, overcapitalizing, piling way too much cash in the account. Yeah, it's safer from a margin perspective, but it absolutely crushes your overall return on capital. Plus, you're taking on more risk if your broker, goes bust.
So what's the just right porridge here? Well, Carver is super clear about it. I generally advise full capitalization, putting all your notional trading capital into your account. No more and no less. Basically, you treat your brokerage account like its own little world. Decide on your trading capital, put exactly that amount in the account, and that's it. No more, no less. It makes risk management way simpler and forces you to be disciplined. Okay, now things get a little more complicated, especially if you want to trade internationally. So let's say your account is in US dollars, but you're eyeing a futures contract that's priced in euros. Now you need euros to cover your margin. What do? Well, you've basically got two main options.
Okay, let's break this down. Option 1 is the FX trade. Simple enough. You sell some of your dollars and buy the euros you need. Done. Option 2 is the FX borrow. This is where your broker just lends you the euros. The real trade-off here is cost versus risk. If you do the trade, you own the euros, which means you're now exposed to the ups and downs of the euro-dollar exchange rate. But if you borrow, you avoid most of that currency risk. But you're going to be paying your broker interest on that loan. And guess what? The interest rate they charge you is probably not going to be a great deal for you.
So what's the play here? Well, for most of us retail traders, Carver's advice is pretty straightforward. Go with the FX trade. Why? Because those interest costs from borrowing, they really add up over time and can be a serious drag on your performance. It's usually just better to own the currency, take the hit on the transaction cost, and just accept that the little fluctuations in the exchange rate are just going to be noise in your P&L.
All right, now we get to the big one, the concept that can literally make or break your entire trading career, compounding. How you choose to handle your profits and your losses, this is probably the single biggest decision you'll make for your long-term growth. And Carver breaks it down into 3 very different methods. First up is method 1. And I'm going to be blunt.
This is the one you should never, ever use in a live account. It's called fixed capital. The idea is that your position size is based on a fixed number that never changes. So look at the example. Even after you lose money and your account gets smaller, you keep trading the same size. It's insane. It's so dangerous because as your account shrinks, your risk is actually going up relative to your capital. It completely breaks the #1 rule of risk management. Okay, method 2. This is the growth engine. It's called full compounding. Here, your position size is always a percentage of your current account value. It's dynamic. So when you win, your account grows, and you automatically trade a little bigger. But, and this is the beautiful part, when you lose, your account shrinks, and you automatically trade smaller. That automatic scaling is what protects you during a bad run, and it's why this is the go-to method for institutions and anyone who's just focused on one thing, growing that account over the long haul. But what if your goal isn't just to grow the account forever? What if you actually want to, spend some of that money? Well, that brings us to method 3, which is a really clever hybrid called half compounding. It works like this. When you're losing money, you behave just like a full compounder. You cut your size and protect your capital. But when you're winning and your account hits a new all-time high, you don't increase your position size. Instead, you treat all those new profits as cash you can withdraw. You're literally taking your winnings off the table. So to wrap it all up, it's about picking the right tool for your specific goal. Fixed capital? Just no, don't do it. Full compounding? That's your jam if your one and only goal is maximum long-term growth. And half compounding? That's perfect for most retail traders who want to protect their downside but also want to be able to pull profits out. I love how Carver puts it. It's like turning your account into an ATM that spits out money randomly. Who wouldn't want that? So when you pull back and look at the whole picture, how you handle your margin, how you capitalize your account, and how you compound your returns, you start to see that this stuff isn't boring accounting. Not at all. Smart cash management is your strategic co-pilot. It's the system that's constantly making adjustments to keep you flying safe and sound. So your actual trading strategy has a chance to work without you flying straight into a mountain. So that really leaves just one question for you to think about. What's your goal? Are you in this to build a massive nest egg for the future? Or are you looking to create a stream of income right now? Because the answer to that question will tell you exactly which one of these compounding strategies is the right engine to power your own trading journey. When we think about professional trading, our minds usually jump to the huge wins, the brilliant calls on the market. But the real secret weapon, the thing that really separates the pros from everyone else, is something way less glamorous: risk management. So today, we're going to build a fortress around our capital. We're going to take a look at how the pros think not just about winning, but about surviving. And to kick things off, let's start with this classic quote from the movie Margin Call. It's just so darkly ironic, isn't it? The risk manager is the first person they fire right before the whole firm realizes he was the only one who saw the iceberg coming. It just highlights this crucial truth. Risk managers are the unsung heroes of finance, and what they do is absolutely vital. And that's because, at the end of the day, survival is everything. See, most people are just focused on making money, but the professionals, they are obsessed with one thing: not losing at all in a catastrophe. They know you can't win the game if a bad week knocks you out of it completely. So let's start building our fortress. And the first step is really understanding why risk management is the true unsung hero of this whole story. Okay, the first layer of our fortress, our first line of defense, is all about surviving the most immediate gut-wrenching threat to any leveraged trader. Because let's be clear, if you get a margin call, your risk process has already failed you. So what is that most immediate danger? It's not the market crash itself, not exactly. It's that phone call or that email from your broker that makes your stomach drop, demanding more cash right now, or they start selling your positions for you. It's the dreaded margin call. And hey, this isn't just some textbook theory. The author of the material we're looking at shares this wild personal story from 2018 from an event they nicknamed Volmageddon. It was a day when the VIX, the market's fear gauge, literally doubled in a single session. Margins for VIX futures just exploded, and he had to move fast to avoid getting liquidated. This stuff is real. So the key is to have a plan before the chaos hits. And it's actually a pretty simple 4-step process. First, you measure your margin usage every single day. Second, you set a trigger, a line in the sand, let's say 60% usage. The moment you cross it, alarms go off. Third, and this is crucial, You define your action in advance. Something simple, like cutting all positions by a certain percentage, is usually best because it doesn't require any thinking in a panic. And finally, you know how to get back to normal. Like, once usage drops back below 50%, you can reverse the action. It's simple, it's systematic, and it can save your skin.
All right, so once we've secured our flank against that immediate threat of a margin haul, we can build the core of our fortress. This is our second, much more sophisticated layer of defense, an automated risk shield that is constantly scanning for dangers you might not even see. Now, this shield basically has 4 different sensors, and each one is looking for a very specific kind of danger. You've got your estimated portfolio risk, which is like the day-to-day weather forecast. Then there's jump risk, which prepares for hurricanes. Third, you've got correlation risk, which protects you in case the hurricane hits at the same time as an earthquake. And finally, leverage risk. That's just a simple hard stop button. We're going to dive into those first 3 dynamic sensors right now. The first danger this shield is on the lookout for is a sneaky one. It's when your portfolio's expected day-to-day risk just suddenly spikes. Not because you made a big bet, but because of some weird, perfect storm of random correlations and position sizes. Now take a look at this. What's kind of wild is that your portfolio's expected risk isn't some flat, stable line. It's all over the place. Those peaks you see? Those are the moments when a bunch of seemingly unrelated things all line up just right to make your portfolio way riskier than you intended, even if each individual trade looks perfectly fine. So how do you defend against that? With a really elegant rule. Now, there's a formula on the screen, but please don't worry about the math. Just think of it like this. It's a simple if-then rule. If the expected risk shoots above our ceiling, let's say 30%, then this multiplier kicks in and automatically scales everything back down until it's safe again. It's like an automated governor on your risk engine. All right, danger number 2. This is the one that gives experienced traders nightmares. The quiet market. It's that eerie calm before the storm, because low volatility periods often end with a sudden, violent explosion that normal risk models, which are just looking at recent history, completely miss. So to handle this, we create what's called a jump risk profile. What this chart is showing you is the portfolio's risk if we assume every single thing in it simultaneously experiences its worst day ever. As you can see, it's a much, much scarier picture. This is how you plan for the improbable but totally possible disaster. And this leads us to the solution. Again, don't focus on the formula, focus on what it does. This is another multiplier, but this one is designed specifically to guard against those nasty fat tail events. When that jump risk number gets too high, this multiplier forces the portfolio to shrink, protecting it from a sudden volatility explosion. Okay, on to our third dynamic danger. What happens when your diversification just fails? You know, you might own stocks and bonds, thinking if one goes down, the other will go up. But then a real crisis hits, and they both crash at the exact same time. That's a correlation shock. So to guard against that, we calculate a correlation shock risk. This chart visualizes what happens if we assume the absolute worst, a scenario where every single correlation in the portfolio conspires against us at the same time. It's the ultimate stress test for your diversification plan. And you probably guessed it, we've got a multiplier for that too. If the risk of a correlation shock gets too high, this rule scales back positions. This is your defense against a total systemic failure of your portfolio's internal structure, for when all your assets decide to gang up on you. So, the system looks at those 3 dynamic risks we just talked about: portfolio risk, jump risk, and correlation risk, plus that simple hard leverage cap, and it always picks the most restrictive one. And the result is what you're looking at right now. This is the final risk multiplier in action. And what's so cool is that for long stretches of time, it does absolutely nothing. It just sits at 1. But then, during specific moments of crisis, you see it in 1980, 2008, 2018, it springs to life and automatically cuts risk. It's a silent guardian that only shows up when you need it most. And that brings us to the final layer of our fortress. These are the unbreakable outer walls. These are the hard, non-negotiable limits that protect you from everything, including yourself, and maybe even a bug in your own code. The source material has this absolutely incredible story to illustrate this point. Early in his career, because of a simple coding error, his system tried to buy a position in Korean bond futures that was worth $100 billion. He gets a call at 1 a.m. from a trader who just asks, "Mate, Did you really mean to buy 1/3 of the entire outstanding national debt of Korea? Luckily, a human caught it. But in a fully automated world, you need absolute limits.
And this is how it works in practice. You calculate a position limit based on a few different rules. So for this euro-dollar example, maybe your trading signals says you should buy 23 contracts, but your hard leverage rules says you can only have 4. And another rule, based on market liquidity, says the limit is 1,600. So which one do you use? Simple. You always take the lowest number. In this case, it's 4 contracts. That becomes your unbreakable wall, no exceptions. And that really brings us to the final question, doesn't it? After building this entire fortress, layer by layer, from the margin defense to that dynamic risk shield to the absolute hard limits, you have to ask yourself, is my strategy just built to perform when times are good? Or is it truly built to survive when everything goes wrong? Because in the long run, that's the only thing that really matters.